Happy morning, people. Hope you're all doing good. So, in the today's session, we'll be running through FR RTP May 2026. I'm sure the moment you looked at RTP, you saw a lot of amendments being thrown across. So, 14 pages, 15 pages amendment was inserted in this RTP. So, yeah, there's a lot of halagulla that there's a lot of amendment or changes in FR. So, before we go through now this particular RTP questions, we'll cover those amendments. In fact, majority of the amendments are theoretical in nature. They don't have much of you could say practical in relevance. Most of them are disclosure requirement. They could be say in reality you could say there is one amendment which could have a practical implication or a number driven. You could expect a question out of that with numbers. That you could really call it as an amendment. Rest everything is just you could say add-ons, extra. Okay. So now that particular amendment first I'll cover. Then I will run you through another 3-4 amendments, whatever has been inserted. We'll do the amendments first and then take up the questions of RTP. Fine. That's going to be the this session ka overview. And for those people who have purchased our classes, this particular RTP section, first we'll be covering amendments, right? So there is one amendment on Ind AS 1, which we have solved multiple questions. I think this questions you could see in Ind AS 1 as well as Ind AS 10, right? In that there is a change. So first I'll cover that. So this particular video, I'm going to put it under Ind AS 1 as well as under, we have previous year RTP, MTP section in our course. I'm going to update the same video. Is going to be copy pasted there also. At multiple locations we're going to put so that at least one of the sections you see and you get this done. We'll try to also upload this in YouTube, so at least there you will be able to, if you miss these, at least you can watch it there. Fine, people. So that's the overview. So now without further delay, let's go into the amendments. So this amendments came in your RTP May 26 release. So first we will go through this. So one amendment on Ind AS 1, people. Okay. First, there are 2-3 amendments over here. The one is current liability ka definition mein there is an amendment. Current liabilities, we had 4 components. Current liabilities are those which are held for trading purpose. They're expected to be settled within 12 months from the balance sheet date, or they are expected to be settled within operating cycle, right? There were 3. The 4th one was current liabilities are those liabilities where company does not have unconditional right to defer the payment beyond 12 months from the reporting date. This was the 4th component of current liability, if you remember, in AS 1. And by the way, people, watch all these amendments only when you have done with your syllabus, right? Because you need to know before, because we are now talking about the change. The change will make sense only when you know the original one. So, okay, first revise your syllabus and then go through your RTP section. Directly don't start with this. You may not get it. Yes. So now what is amendment in Ind AS 1? This current liability ka definition is this word unconditional has been removed. That's all. Right? The 4th point stays as it is. This word unconditional, that alone you remove and the rest becomes legal. So current liabilities are those liabilities where company does not have unconditional right to defer the payment beyond 12 months. That you'll have to rewrite that definition like that. Cut off this word unconditional. That's all. Okay? Faltu. Right? Okay. Next one is, this is something which I feel you could get some questions out of this. So what is this? If you remember, we have we have taken a long-term loan and the company does some breach. Due to that breach, the long-term loan has now become repayable on demand, meaning it has become current liability, right? There were 2 cases where one case my bank will ignore the breach, or another case my banks used to give a grace period. I'd given a big chart for this for you. Right? And we had covered 3-4 questions. So in that there is a small amendment. Okay, so we'll go through that. Yes, first part I think you already knew, so it's once again reiterated. So I've taken a small example just to illustrate this. Let's say a company has taken a 10 crore loan for 7 years. So long-term loan. Okay, but one of the conditions, covenants means requirements. Covenant in fact means restrictions, right? Okay, one of the requirement or restriction here is the promoter's contribution is required for 10 crore before 30th June. So bank has put some condition. I'll give you a loan for 7 years. I'm fine. But if I have to give you the loan, you also need to take a similar contribution from a promoter. Promoter also has to infuse or bring in how much money into the business? 10 crore before 30th June 2026. But our current year is ending on 31st March. That means still 3 months is there for us to fulfill this condition. Our current year has ended on 31st March. 3 more months is there for the company to fulfill this particular promoter's contribution requirement. Okay. Now what do you have to do? Now in the current year, is there any breach? Can you say is there any breach? No. Company has time till what? 30th June 2026 to get this promoter's contribution. On 31st March, we don't even know because we still have time, right? There is no breach in the current year. If there is no breach in the current year, then this particular year, current year, the loan will be classified as a non-current liability. Straightforward, yes or no? Because there is no breach in the current year, so the loan will continue to be shown as a non-current liability in our books. Okay, one case. Modifying this case, let's say in the current year itself, 31st March itself, company knows what? That they will not receive this promoter's contribution by 30th June. On 31st March only, company knows that what? Promoter will not be able to get 10 crore rupees within the next 3 months. So company knows that the breach will happen in the next 3 months. On 31st March only, company knows in the next 3 months, breach will happen. If that is the case, means what you will do on 31st March is an illustration. Breach has not happened, but company knows on 31st March, breach will happen after 3 months because promoter will not get the money. In that case also, on 31st March, the loan will still continue to get classified as non-current liability only. Why? Because on 31st March, there is no breach, right? Company knows that breach may happen after 3 months, but on 31st March, is there any breach? No. So on 31st March, company will still continue to show this liability as a non-current liability. Fine, now people. Okay, classification will be same, NCL only, but you give a disclosure. If company knows that the breach might happen in the next 3 months, in the current year financial statements on 31st March, company should just give a disclosure that we are anticipating a breach to happen. Like that disclosure is enough. Reclassification from non-current liability to current liability not required. So finally, this loan will still continue to be shown as a non-current liability. So finally, end goal is what? For you to change the classification from NCL to CL, breach should have happened on what day? 31st March. If breach has not happened, means the loan will continue to get shown as a non-current liability itself. This is one part. Easy, I hope. Okay. Now let's go for the next one. Okay. This is really, in fact, you could say an amendment or a change. Now, breach of long-term covenants. As I told, covenants is nothing but your restrictions, borrowing restrictions, or it could be whatever sort of a restriction, borrowing restriction or this restriction or whatever. Okay, check. Now, first I will cover what we have learned. What is that provision we had? First, I will take you through that. Then I will tell you what is that new provision or new amendment which has come here. Okay, so that we'll understand the context, because we have solved all our questions in this provision. Okay, once we know that or recap that, and then it will be easy for us to review the amendments. Yeah. Okay. Now, till, mind you, whatever old provision or existing provision was there, that will be applicable till 31st March 2026. So whatever problems we have done in our class, right, we have done using old provision or existing provision, right? That existing provision will hold good. It is applicable till what date? 31st March. That means new provision will be only applicable from 1st April 2026 onwards. So when question comes on this, watch out for the date. If they by chance say for 31st March 2026, what is the treatment? You'll have to give the treatment as per the old provision. By chance, if they modify the question and ask for a period greater than 31st March, suppose they make the period as 1st April 2027 or 2028, and then ask you the question, you'll have to answer based on the new provision. It's easy only, one-liner answer only, but still dates are important over here. Watch out for that. That is one. Okay. What was our existing provision? Again, let's learn it with the help of a small example. Let's say current year is ending on 31st March 2026. Okay. So on 1st April 2025, beginning of current year, company took a loan of 15 crore for 7 years. So long-term loan they have taken. Let's say from a bank. But one of the covenants or one of the restrictions or one of the requirements is debt equity ratio should not exceed 2:1. Bank has told the company your maximum debt equity ratio should be 2:1. Meaning for 1 rupee equity, maximum debt you can have is only 2 rupees. This should be maintained by the company at all times. Suppose if this is breached, or if this provision of debt equity ratio, if it is violated, then the loan will become repayable on demand. That's what loan agreement with the bank says. Okay. Now on 31st March 2026, right, company did a breach, meaning debt equity ratio, let's say, became 3:1. Debt equity ratio became 3:1. Maximum debt equity ratio should be 2:1. Let's say on 31st March, debt equity ratio became 3:1. So this particular condition has been violated. So there is a breach. So breach has happened. The moment breach happens, what does the loan agreement say? The loan becomes repayable on demand. If any liability is repayable on demand, it is no more a current liability. It is no more a non-current liability. Rather, now it becomes current liability. Since it is repayable on demand, now it is no more non-current liability. It is current liability. Correct? So this is a drama on year ending date. Okay, after this, what happens? Now the bank, if the banks ask the money, all the company people will go to branch managers, commission and put butter up. Ignore macha, leave da macha, come da macha, like that. So let's say on 25th June 2026, financial statements of current year, let's say is approved by 10th July. Current year financial statements have got approved by the board on 10th July. Before approval date only, that is 25th June. Let's say bank people convinced, company convinced the bank people, company convinced the lenders as to what? The lender has agreed not to demand repayment. Bank is saying, okay, oofi macha. This time I will ignore this particular breach, or a grace period is given to rectify this breach of 12 months or more. One of the two things can happen. Lender either can ignore the breach, or extra time period of 12 months or more can be given to correct this particular breach. Okay, now, so if this happened, what we used to do, since this particular event, this particular lender not agreeing to demand the repayment of grace period giving of 12 months or more, if it has happened, since it has happened within the financial statement approval date, we used to treat this as an adjusting event. We used to treat this as an adjusting event and rechange the classification from current liability to non-current liability. Okay. First, it was non-current liability. Then, since breach happened, we changed it to current liability. Since the lender has not chosen to demand the repayment, again from current liability, the classification will be changed to non-current liability. Yes, sir, people. This is what we used to study. Okay, this is what we have solved 2-3 questions based on this provision. This is our existing provision, mind you, whatever we had currently. Now, what about the new provision? If you remember, I had told you this is a carve out. In class, when we did a question, I said this is a carve out, meaning IFRS says something, Ind AS is saying something else. I told you in class, as per IFRS, it's a current liability. As per India, we have interpreted this to be a non-current liability, is what I told. That is what is the amendment. What does new provision says is same case. So same, you have taken a loan, breach has happened. I've just copy pasted double case. Okay, we have taken a loan on 31st March, but I've changed the period because this provision is applicable from 1st April 2026. Suppose same loan if you take on 1st April 2026 and on 31st March 2027, if breach has happened, the moment breach happens, it's a current liability. Then financial statement, let's say, is approved on 10th July 2027. Before approval only, lender has chosen not to demand the repayment or given a grace period of 12 months or more. Same condition I've given, just wherever there is 2026, I've substituted with 2027. If this has happened in next year, means what? Now the amendment or what the change says is, since on 31st March breach had happened, since on 31st March year ending date a breach had happened and it has become current liability, no? So that means you show this particular on 31st March current year, you show this liability as a current liability only. Meaning now you don't treat this as an adjusting event, you treat this as a non-adjusting event and let the classification of loan be current liability only. Okay, that's all is a change. Okay, the thought process here again is, since the breach has happened on 31st March and the loan is repayable on demand, ideally this loan should be shown as a current liability in the current year. That's all it is. So it's no more non-NCL, it is current liability CL. That's all. This is the change. Okay, people. And this could have, you need to write the provision and give an answer. You could come for 1 marker or a 2 marker, or it could be a 4 to 5 marker question depending on how the ICAI frames the question. Okay. That's about the major amendment that we had to know. Rest everything is pretty faltu, right? So another one is same in Ind AS one only, current non-current classification for convertible debt. If you remember, when you have compound financial instrument, there will be equity portion also, there will be financial liability portion also. So what this amendment says is, ignore the equity conversion option and classify financial liability into current liability, non-current liability in a normal way. Normally people, when you take CFI, let's say I've given an example, CFI you have taken for 10 lakh. So right, in CFI you have to split between FL and your equity. Let's say FL portion is 8 lakh, equity portion is 2 lakh. On your financial liability portion, you do the ACM table. I've just done it for 1 or 2 years for reference. Whatever is the term, if the term is 5 years, you'll put up ACM table for 5 years, correct? Now whenever you have a closing balance of financial liability, right, you need to show how much portion of this 8,10,000 financial liability is current and how much is it non-current. So whatever normal way you used to classify this, continue with the same thing. Meaning sometimes what happens, if a company is sure, if company is reasonably certain that they may not go for settlement option if they go for conversion option, right? Because at the end of the year on the term, let's say if the term is 5 years, in the 5th year, this particular instrument may be settled by cash also, or it may be settled in shares also. So if company feels they're going to settle this particular instrument by issuing equity shares, company feels that they might settle this particular instrument in equity shares. Still, like since it is CFI, you do the split and you classify this financial liability as current and non-current in the normal way, the way you used to classify this in the same way. Current liability means something which is settled within the next 12 months. So in this portion, 8,10,000, how much ever portion is going to get settled within the next 12 months, you will classify it as current. Balance will get classified as non-current liability. Okay, now people, continue with the same things. You don't have to worry about equity go over here. Fine, that we will see at the end of the year, at the end of 5th year. On the settlement date, we'll worry about that. Till that settlement date, whatever normal classification you used to do, continue with that. Is this more, instead of amendment, you could say this is more like a clarification given. This is what any which way we used to do. So they're saying continue with that. Okay, people. This is with respect to Ind AS 1 amendment. The main portion is this loan covenants. That I feel might have a relevance in exam. Other than that, I think pretty much everything is pretty straightforward stuff. Okay. So now we will go for the other things. All other amendments, people, are more theoretical and disclosure requirements. Okay. 1 or 2 marks ka theory can be expected. Question so far though looks little doubtful. But anyways, let ICAI build it and then we'll talk about it. Okay. Alright. Next amendment is on Ind AS 21. What is this Ind AS 21, guys? This is about lack of exchangeability. Lack of exchangeability. Now, people, Ind AS 21 is applicable for foreign currency transactions, right? Now, let's say what is this lack of exchangeability that we are referring to here is, suppose people, we are in our functional currency is INR. We are operating in INR environment. We have done a particular transaction, let's say in Chinese currency, CNY or yuan or whatever you want to call it. Okay. So, you have done a particular transaction in Chinese currency. Now, from Chinese currency, you need to convert it into Indian currency or vice versa, depending on whether you need to receive or pay or whatever. Correct or no? All right. So now this particular amendment is trying to say, can we exchange from INR to Chinese currency or vice versa easily? From INR, can you convert it into Chinese currency, or from Chinese currency, can you convert it into INR easily? So what sort of a question is this, sir? This is very easy, no, sir? Yes, it is easy only, yes. Sir, when you talk about Indian rupees, INR to dollars, INR to pounds, maybe INR to Chinese currency, it may be easy. When you have done a particular transaction with, let's say, a remote country ka, some corner ka country, some not so famous country ka, if you have done any transaction, you need to check whether the currencies are interchangeable. Can you convert? Because there may be a possibility that this particular from INR to that foreign currency or foreign currency to INR, you may not be able to easily convert. Especially now the war is going on, right? It's a war-like environment. So each country, there might be some difficulty you might face in conversion. If at all you are facing this difficulty in conversion, then only this amendment will come into picture. Okay, this is more of a disclosure thing. Okay. All right. If you are able to convert, no drama. Whatever you've been doing it, do it aramse. If you are not able to convert it into from INR to your foreign currency or foreign currency to your INR functional currency, then only this particular amendment becomes relevant. Okay, people. Okay. Now, first, lack of exchangeability. Okay, first check that. So here they have suggested two-step approach in this particular amendment. Okay, first step is to check whether the currencies are exchangeable. Can two currencies exchanged among each other? That is the first step. Check whether it is exchangeable. Now, in order to say that currencies are exchangeable, they have given some indicators. Indicators means you don't have to check for all the things. You can look for maybe majority or anything. They have not said use the word and there. Okay. All right. First one is time frame. Time frame means, sir, normally when you do a particular transaction, can you take your own sweet time? No. Right. Now, we have maybe another 20 days for our examination. Correct? No. So that means within 20th day, you have to write the examination. You can't take your own sweet time. You can't tell ICAI, I need 45 days. My preparation is pending, right? It will not work. Same way, in point number 1, they're saying is, can you exchange the currency within the time frame? Let's say I need to convert from INR to Chinese currency within, let's say 20 days. I need to convert from INR to Chinese currency within 20 days. So check within 20 days, is it possible to convert from INR to Chinese currency or other way around? If it is possible, if you say yes, it's possible for me to convert it within 20 days, then we say yes, this particular currencies are exchangeable. If it is exchangeable, you don't have to do anything. This amendment is applicable only if the currencies are not exchangeable. If it is exchangeable, continue with your normal Ind AS 21 provision, absolutely no change. Fine. Now, that's your first thing. Can you exchange it within the required timeline? That could be 20 days, 1 month, 45 days, whatever. First one. Second indicator is, do you have the ability to obtain the other currency whenever you want? Now, people, they've just taken this and just extended it. Now, I don't have any timeline. Like 15 days, 20 days. Okay. I may need it within 4 months also. I may need it within 6 months also. I may want it within 1 year also. Right. So whenever you want it, in whichever time frame you want it, 1 month, 2 months, 4 months, whatever, is it possible to exchange? So can you exchange whenever you want? So if you say, now if you're operating from INR to dollars, INR to Chinese currency, all these are major currencies, easily you can exchange, yes or no? So if the answer to this is yes, no, I don't have a timeline, but whenever I need it, I'll be able to exchange it. So if you have the confidence, if you feel your environment suggests that, then you could say the currencies are exchangeable. Fine, that's what this particular point is trying to say. Third one is, okay, you are exchanging the currency from INR, you're going from Chinese currency. You are operating through a normal exchange mode, or are you buying it through black market? Okay, normal, or what is your exchange mechanism? Where are you doing this exchange? Through the acceptable exchange mode or black market? If you say in the normal market, if you are exchanging, then the currencies are exchangeable. Suppose you say, no, it is not available in the normal market. Oh, now I have to buy it from the black market. Like our gas, now gas issue is happening, right? We are not able to get the gas through our normal mechanism. Now we are buying things through offline mode, correct? Now by paying extra amount to, we are catching hold of the cylinder guys and asking for that, all that. So all that is black market wala transaction. So if you are able to exchange that currency only in black market, then we say currencies are not exchangeable. For you to call it as exchangeable, it should be in normal market. That is one. Okay. All right. Next is purpose of obtaining the other currency. Now let's say, one second. Okay. Let's say people, I need this particular Chinese currency to pay, let's say, dividend. I have a Chinese investor. I have to pay them the dividend. I don't want to pay the dividend in INR. I have to pay the dividend in, let's say, Chinese currency. Now, let's say there is a restriction. For a dividend payment, I will not be able to convert from INR to Chinese currency. There is a restriction. Okay. So, if for the purpose for which what you want currency, for that purpose, if you are not able to exchange a currency, then we say currencies are not exchangeable. Okay. Let's say for buying, let's say I have imported a property, plant and equipment. I have purchased a property, plant and equipment from China and I have to make the payment in Chinese currency. For that purpose, it is allowed. For making the import payment for PP, I can exchange the currency. But for dividend payment, it is not allowed. Right? But let's say, so that's what this point is trying to say. For the purpose for whatever you are making the payment, if you are able to exchange the currencies, then currencies are exchangeable. But for your purpose, if you are not able to get the currency, then the currencies are not exchangeable. So for whatever purpose you want the currency, for that purpose, are you able to get it or not, is what this particular point is trying to say. If you are able to get it, awesome. Then currencies are exchangeable, so you don't have to do anything. For whatever purpose you want, for that purpose, if you are not able to get the currency, then currency we say are not exchangeable. If it is not exchangeable, what to do? I'll tell you in the next step. Okay, this is one. Next one is ability to obtain the limited amount of other currency. Now let's say people, I want, let's say 1 crore worth of Chinese currency. I need 1 crore worth of Chinese currency. But in the market, I can get only 10 lakh. I want how much? 1 crore rupees Chinese currency. 1 crore rather Chinese currency. But in the market, how much is available? 10 lakh. That, if that is the case, means we say currencies are not exchangeable. Why? Sir, I need 1 crore Chinese currency, but I am getting only 10 lakh. So if you are able to get the currency for full amount, for whatever amount you want, if you are able to get it, then we say currencies are exchangeable. If you are not able to get the amount that you want, then we say currencies are not exchangeable. So I want 1 crore Chinese currency. If I'm able to get that, then we say currencies are exchangeable. I want 1 crore, but 1 crore is not acceptable. If I get a lesser amount, then we say currencies are not exchangeable. Yes, sir, people. So these are some indicators. Okay. So based on these indicators, we prove whether the currencies, two currencies are exchangeable or not. If the currencies are exchangeable, then you apply normal Ind AS 21 ka provision. Absolutely no change, right? Whatever you've been doing, we know no Ind AS 21 ka provision. Initially, all transactions are recorded at transaction date ka spot rate, settlement at settlement date ka spot rate, SDSR we used to call it. So all those normal provisions will apply. If by chance, after applying these indicators, if you conclude, if you come to a conclusion, what is that? That currencies are not exchangeable because indicators failed. Because indicators failed, and what are you concluding? Currencies are not exchangeable. So if you conclude currencies are not exchangeable, then this was step number 1, right? Then only you will proceed to step number 2. If currencies are exchangeable, that's it. Answer stops at step number 1 and do your normal Ind AS 21 ka accounting, whatever you're doing, continue with the same. No extra disclosure, nothing. All good. If only step number 1 fails, or as per step number 1, you conclude, what is the conclusion you will draw? That currencies are not exchangeable. Then only you will come for step number 2. What is step number 2? Step number 2 is, sir, people, since you feel currencies are not exchangeable, but for accounting, we need spot rates, right? Initially accounting, we have to do in TDSR, SDSR and all this, right? So you in second step, since you concluded currencies are not exchangeable, in second step, you'll have to estimate the spot rate. It's like a fair value, people, right? If you have a fair value of from active market price, you take that and you move on. If active market ka fair value, if it is not available, then you estimate, right? We have various methods to estimate fair value. Here also same thing, right? If the currencies are not exchangeable, then you find out the spot rate through certain methods. That's all is a step number 2. Okay. Same as fair value in a way. Okay. So one way to estimate spot rate is check if observable exchange rate is there without adjustment. Okay. Meaning a similar exchange rate, can you take it without doing any adjustment? Like, just to give you an example, different purpose rate. Like previous case, I told, sir, I have a Chinese investor. I have to pay that particular Chinese investor a dividend in what? Chinese currency. But currently the law of a country or whatever, okay, there's a restriction saying for dividend payment, Chinese currencies, Indian currencies are not exchangeable. For other purpose allowed, but for dividend purpose not allowed, let's say. Okay. So here what do we do is, now I have to pay, right? So what this particular standard says is, okay, anyway, for dividend purpose it is not allowed, but for other purpose it is allowed. Other purpose could be your PPE ka payment or whatever, right? So take that other purpose ka payment ka spot rate itself and use it for your dividend remittance purpose. Substitute, right? Whatever for other purpose you have that spot rate. For PPE payment it is allowed. Now, let's say for PPE payment, the exchanges, for 1 rupee, 1 rupee is equal to 0.5 of Chinese currency. But now I want it for dividend remittance. This exchange rate only can be used for dividend remittance purpose also. Okay, this is not exactly for dividend remittance purpose, but it is for a different purpose. But same can be used for dividend remittance purpose also. That's what it is. So it's a substitute basically. Use the other purpose ka spot rate for this purpose also. Okay, this is one. Second one, rate after the restriction is removed. Let's say people on 31st March 2027, exchange is not possible due to war or due to whatever circumstance. Let's say on 31st March, there is a restriction. Indian currency and Chinese currency cannot be exchanged. What day? 31st March, it is not allowed. Okay, whatever reason. I've just written war for an example. Let us say up to 10th April, it is not allowed. From 31st March to 9th April, you could say rather, the exchange of Indian currency, Chinese currency is banned due to whatever reasons. Fine. No, Chinese app and all be banned. No, like that, let's say from 31st March to 9th April, for those period, exchange of Indian currency and Chinese currency, let's say, got banned. Right. But from 10th April onwards, the exchange, that ban was lifted, meaning the exchange is permissible. India and Chinese currency, you can exchange. On what day? 10th April. Right. Now, but we need the rate on 31st March for our accounting. Right. So what this particular standard says is 31st March rate not available. No problem. 10th April rate is available. Yeah. Take this only for 31st March ka accounting. But don't take it as it is. You may have to do some adjustments because this is a rate after 10 days. Now. So you'll have to consider the inflation or the future value type, present value wala calculations. Okay. So this is the things. So if that day ka rate is not available, but a future rate is available, you can take the future rate and do your accounting, or you can estimate that spot rate can be utilized, but you need to do certain adjustments for the time gap in inflation, etc., etc. That's all it is. Fine, people. Okay, another estimation technique or any other estimation technique. What is another estimation technique? Let's say people from INR to Chinese currency, okay, you can't exchange. From INR to Chinese currency, you can't exchange. But let's say there is another route possible. What is that? First, from INR, you can convert it into dollars, and from dollars, you can buy Chinese currency. Let's say this route is permitted. Rupees to Chinese currency not allowed due to whatever restriction. But first, using rupees, you can buy dollars. Through dollars, if you can buy Chinese currency, this route is allowed. That means you can apply this. Using this, you can find out what is the Chinese currency you are able to acquire. Okay. So if this route is permissible, then you can use that. But hang on. Now you are not doing a direct conversion from rupees to Chinese currency. From rupee, first you're converting it into dollar, and from dollar to again Chinese currency. That means you have to incur the conversion cost two times. No. So that's what the standard says. So adjust for any delay or extra transaction cost like brokerage or commission that you may incur, because you're not following a direct route here. Okay, instead of going like this, you're going like this now. So extra cost is coming. Rupee to dollar conversion, again dollar to Chinese currency conversion. So if some extra brokerage or commission is coming in, take that into account also before you take the spot rate. Fine, that's what this is all about. Okay. So why are we doing all this, sir? The main point of all this is, sir, if currencies are not exchangeable, you need to give disclosure. This is the main mudda. Okay. If currencies are not exchangeable, you need to give a disclosure, and disclosure is also pretty straightforward only, people. Now you tell me what and all disclosures you may have to give. First, you need to tell which currency are not exchangeable and why is it not exchangeable. What sort of a restriction is it? Like there is a restriction due to war. Okay, there is a restriction due to some whatever is the reason for which the restriction has come in. So bring in that. Which currency ka lack of exchangeability is there, and why? What is the reason for this lack of exchangeability? Call out. That is one. Next, you tell which transaction is affected. Your purchase transaction is affected. Sale of goods transaction affected. Purchase of PP, purchase of intangible asset, dividend remittance. Which transaction got affected due to this particular lack of exchangeability? Call out that. Next, which particular asset liability, with carrying amount of assets and liability which got affected, that you need to mention. And fourth one, how did you estimate the spot rate? Okay, how did you estimate the spot rate? Which route you took? Okay, there are many routes where many methods suggested now. So using which method did you find out the spot rate? Disclose that. Then what are the risks you are exposed to? So call out that. Next point is, suppose I have a foreign operation. My currencies are exchangeable. I'm a parent entity in India. I'm not facing exchangeability issue. Mine, everything is good. But I have foreign operations, let's say subsidiary company or associate or joint venture. They are facing this lack of exchangeability issue. Parent entity, me, I am not facing exchangeability issue. Who's facing? My foreign operation. If they are facing exchangeability issues, then you need to disclose what. Now, which foreign operation is facing this issue? And okay, and then you have to just give that financial summary of this particular financial operations. It's a basic data, right? So again, that particular foreign operation, which asset is getting affected, so what is the impact, etc., that you need to call out. So main mudda is only this, people. If there is a lack of exchangeability among currencies, you need to give a disclosure. These are the disclosure. Pretty straightforward. Okay, now. So you might get a straightforward theory question out of this. I don't expect anything beyond that to turn up. Okay, pretty easy. Yes. So Ind AS 1, as I told, I think we have already covered. Next one is your supplier finance arrangement, or SFA. Supplier finance arrangement. What is this? Again, there is a disclosure related amendment. All these are new, right? The only thing we had which we have to worry about is Ind AS 1. Rest everything, whatever we are learning, is an extra. So it's not really an amendment. You could say these are extra fitting. So this is about Ind AS 7 amendment called supplier finance arrangement. Now, what is the supplier finance arrangement? First, this particular SFA, supplier finance arrangement, it's applicable from 1st April 2025. One is that. Now, what is this? Now, let's say X Limited, one company, they purchased goods worth 1 crore from a supplier, from a creditor. Okay. So, X has purchased goods from a creditor, okay, for worth 1 crore rupees. Now, let's say X Limited approached HDFC Bank. X Limited, who has made the purchase, has approached HDFC Bank and told HDFC, you clear the payment to supplier immediately. X is telling HDFC, on my behalf, you make the payment to supplier immediately. and X is telling HDFC, I will pay you after 4 months. So basically we are telling the bank on our behalf, you pay the creditor and we will pay the bank after 4 months. So basically a loan, right? That's only we call it a supplier finance arrangement. In order to pay the supplier, indirectly we have taken a loan, right? But here normally in loan what happens? Bank gives money to X and X will make the payment to supplier. So like this, bank will give the money to X and X will make the payment to supplier. That's the arrangement. But in supplier payments arrangement, okay, HDFC Bank will directly pay to the supplier. HDFC will not pay us. HDFC will directly pay to the supplier. Hence, supplier finance arrangement. Okay, that's the meaning. Next one, sir, if any financial guarantee is given or the payment is made through credit card and all, it is not considered as SFA. Normally, suppliers may ask for some bank guarantees, right? So bank guarantee, if it is given, then it is not SFA. Because in bank guarantee, bank will make the payment only if we default. Otherwise, no, right? If BG will get revoked only in that case, correct? So that is not, if bank guarantees are not SFAs. Similarly, if you make any payment through credit card, again, it is not considered as SFAs. Fine, now there is a meaning. Now, what do we need to know about it, sir? Sir, if you have done any SFA transaction, again, you need to give a disclosure, sir. That's all it is. Pure disclosure wala drama. Okay. What is this SFA ka terms and conditions? Obviously, banks will not do this SFA transaction at free of cost. No, they will charge some commission or interest. So obviously, there will be an agreement between HDFC Bank and X Limited in this case. So that SFA ka summary, that agreement ka summary you give. What terms, how much commission, when you need to pay, what guarantees given, is there any collateral or whatever. Whatever that particular SFA ka summary is there, you give it as a disclosure. That is one. Okay. All right. Next one is what is the amount? How much SFA the bank has given on our behalf to the supplier? That's the amount. So total liability and amount paid by the financial. That is one. Payment timing compared to the normal credit period. Let's say normally creditor gives us a credit of 2 months. Normally our supplier creditor gives us a payment of 2 months. Okay. That means what? Ideally we should make the X Limited should pay HDFC Bank within 2 months because that's a normal credit we get, right? Okay. But here X Limited is paying within 4 months. So that is what they are asking us to compare. What is that payment timing compared to the normal credit period? Here the payment timing is we are paying HDFC Bank only after 4 months. Normal credit which the creditor gives is 2 months. So compare that and both you give it. Okay, for better assessment purpose. Alright, next is non-cash changes. Non-cash changes means business combination. Meaning, let's say people, we don't have any SFA. We are X Limited. Okay, we don't have any SFA. But we have another company, Y Limited, and this is our subsidiary. We are X Limited as a parent and we have a subsidiary called Y Limited. They have SFA. Parent company does not have SFA, but our subsidiary company has SFA. So in that case, what to do? So when you do consolidated financial statement, you take parent and a subsidiary and consolidate, right? Both will be added, right? So whatever belongs to subsidiary, we have to add it. Then only we prepare consolidated financial statement, right? Yeah, that's what they're saying over here, right? Non-cash changes like business combination. If you get any SFA due to business combination, that also you need to give a disclosure. That's all is this particular drama all about. Clear, Sarji? That's again a pure disclosure standard, nothing much to break your head about. Okay. Chumma they have given like 14-15 pages ka amendment wala data, full blade they have put up. Okay. I've just summarized it quickly in these pages for you. Done, people. That's pretty much it. Okay. Alright. There is one last amendment to in Ind AS 12 income tax. DTA, DTL, you know. What is this amendment is? Sir, if due to pillar 2 income tax, if you're getting any DTA or DTL, if due to pillar 2, the question will specify what is pillar 2, okay, because it becomes too much of tax ka jargon, right? I'm sure those of you who have studied tax, you will know this, right? I'll also try to summarize. My tax knowledge is quite limited. I don't know much of it, but yes, to the best of my ability, I'll tell you a little bit of that. So pillar 2 income tax if you have, and due to that, if any DTA or DTL, if it is arising, if it's coming, then for such components, DTA, DTL accounting is not required. Only for pillar 2. If any DTA, DTL is coming due to pillar 2, then no DTA, DTL is required for that. What is this pillar 2 wala taxes? 2 pillar means multiples, basically, multiple tax rate. Now, there was one committee, OECD, they've introduced this minimum top-up tax to be met globally. Minimum top-up tax means extra tax. Now, let's say one company X Limited, we are an Indian company, we are the parent, we have a subsidiary in a foreign country. We are operating in India, but we have a foreign operations called subsidiary, right? But they are operating in a foreign country. Let's say in the country they are operating, the tax rate is only 5%. Our subsidiary operates in one country where the tax rate is only 5%. Good, no? In India, we pay more than 30 surcharge, gircharge and all, full chura we take. Let's say, but our foreign country ka tax rate is only 5%. So that means very tempting, no, this is. Sir, in India, we have to pay more than 35% tax, right? But our foreign subsidiary is only paying 5%, means the parent company may do some jugad. What jugad? Parent company may push maximum transaction. As much as transaction possible, parent company can make it or route it through subsidiary because less tax, no? Right? If parent does the same transaction, they may have to pay on that income 30 plus tax, 30% tax rate plus. But if subsidiary does the same transaction and gets income, right, on that income is subject to only 5% tax rate. So parent may push few transaction or a lot of transaction through subsidiary books. So hence, to avoid this, right? Hence, this committee was formed, OECD, saying if you have a foreign setup, if you have a subsidiary or a foreign operation setup, and if you are operating in a global country, then you can't pay that country ka tax. You have to pay a minimum global tax of 12%. So in this setup, because of this OECD agreement, the subsidiary will not pay 5% tax. They'll have to pay a 12% tax. I've just assumed this. Huh? Okay, I don't know the exact rate, or that you can refer the tax module for the exact thing. So in this case, my subsidiary will not pay 5% tax. It will pay 12% tax rate. So how much extra are they paying due to this particular pillar 2 tax or OECD agreement? How much extra tax subsidiary is paying? Instead of 5, if they are paying 12, the extra tax is 7. This we call it as top-up tax. Now, due to this particular top-up tax, so if you are getting any DTA, DTL, okay, if this particular scenario creates DTA, DTL, then for such components, DTA, DTL accounting is not required, is what the clarification or amendment, you can call it, has been provided. Okay, again, simple, no accounting over here. Since you are not doing any DTA, DTL accounting over here, you just give a disclosure. What disclosure? That we have taken this above exception. So this particular component has come to pillar 2, hence I'm not creating DTA, DTL. Like that, you give a disclosure. One is that current tax related to pillar 2. Because of pillar 2, how much current tax you have paid, that you give a disclosure. And then any qualitative, quantitative information which will help the users. Okay. Then other information, that saying that I'm operating in this country due to OECD, I have to pay this tax. So okay, like that, some qualitative and some extra information you give so that the user can understand this particular data better. That's pretty much about the amendment, people. Okay. In fact, most of them, if you check, were new. Correct. Okay. Only the Ind AS one part was existing, that has got slightly changed. And that too from, remember the date, from 1st April 2026. Watch out for the date. Rest everything is an add-on, and moreover, those add-ons are also more of a disclosure requirement. Fine, people. There's nothing much over here. If you want, I'll ask the team to upload this particular file in our course as well. So if you want, you can download it and do it. So you don't have to go through that 15-page or 14-page RTP once again for this particular summary. Done now, people. Yes, that's with respect to your amendment too. Okay. Yes. So now, okay, we can proceed with our RTP wala questions. Okay, people. So let's proceed with our RTP May 26 wala questions. So overall, if I have to say RTP, maybe one question you could say is good. Newly framed, you could say, easy only, but little new framing. Rest everything is pretty much manageable. Yes, around 4-5 questions are new, you could say, right? But they're all manageable. It's not really something different from the provisions. Okay, so overall pretty easy RTP only. So let's quickly run through those RTP. First, case based question. As I said, whenever they give you a case, first run the requirement and then read the case. This case is anyway pretty small, so it's fine. So if you just check, they're asking standalone selling price of the voucher. Voucher means discount voucher. Maybe Ind AS 115 ka question this is. How much revenue for current year from sale of groceries, they're asking. Okay. And then they are asking, next requirement, what is the value of the liability or deferred revenue? How much revenue are you deferring? Then they're saying some deferred revenue ka theory they've asked. Fine or fair enough. This said liability, it will fall under which standard? Since we're talking about Ind AS 115, Ind AS 115 should be the answer, I think. But anyway, now we'll read. Now we know what it is. We'll quickly go through the case. an entity enters into a contract with a customer to sell the grocery at a market price of 200 rupees. So we sold a particular product to the customer for 200 rupees. And this, because of this arrangement includes 40% discount on future purchase. So because customer purchased 200 rupees from us, we are giving him a discount of 40%. Okay. Now we already studied discount voucher can be considered a separate performance obligation provided it gives a material right. Meaning only by entering into this transaction, you should be able to get a discount. Okay, it should not be a general discount basically. Here, what is it? Simultaneously, seasonal promotion gives all customer a 10% discount. Now, everybody gets 10% discount. Right? That means, is this a material right? Material right means by entering into this transaction, only this customer or a few class of customers should get. 10% everybody is getting. So 10% is not the value of discount voucher. 40 minus 10. So that means 30%. That's what. Therefore, the additional incremental discount, 30%. That 30% portion becomes the value of your discount voucher over here. We have done the same question in Ind AS 115. Only the values are changed. Okay. Entity determines that there is an 80% probability or likelihood that the voucher will be redeemed. Okay. Voucher will be redeemed when the customer purchases the goods in future. And how much do you think entity feels the customer will buy? Entity estimates that the customer will purchase the goods only for 50 rupees. Okay. So now they are asking what is the SSP, standalone selling price of the voucher? That we already know, people. So how much purchase value entity feels will happen in the future? Because to use discount voucher, customer has to buy the goods in future. So future value is 50 rupees. But is there any 100% probability that customer will buy? No, only 80%. So take 50 ka 80%. Okay. So that will become your 15 rupees. Correct. But we want to know the discount voucher ka value. Will customer pay full? No. How much discount? Don't multiply 40%. 10% is given to everybody. So by entering into this transaction, customer is getting an extra of how much? 30%. So multiply 30%. So basically 50 into 80% into 30% if you do, you will get the standalone selling price, SSP of the discount voucher, 12 rupees. Okay. Now what do you have to do? Now we have two performance obligations. One is our main product, grocery. Another one is discount voucher. Right. So the transaction price, what is the transaction price? 200. That 200 now has to be allocated among the main product and the discount voucher. In what ratio? SSP ratio. Standalone selling price of that product, main product is 200 only. The standalone selling price of the discount voucher is 12. So basically the transaction price of 200, you'll have to allocate then 200 is to 12 ratio. Do that allocation, you'll get the transaction price allocated to main product. 200 rupees in this particular ratio. So 188.68 will be the main product transaction price and the balance will be discount voucher transaction price. Okay. In second question, how much revenue they're asking, we will recognize. We cannot recognize discount voucher revenue immediately because discount voucher we can recognize revenue only when performance obligation is satisfied. Now discount voucher performance obligation will get satisfied when this discount voucher expires or when the customer purchases the goods in future, whichever comes early. Correct? No? Correct? Yeah. Because vouchers will have a timeline. It will have expiry date, 1 year, 2 year, whatever, or when the customer buys it, whichever is earlier. Right now we have only sold the goods. So only the main product, grocery ka only performance obligation we have satisfied. So we can recognize revenue only to the extent of 188.68 in the current year. Okay. So how much revenue are you deferring? How much revenue you are not booking? The discount voucher revenue. How much is that? 11.132. That's the next answer question. How much will you defer? 11.32. Okay, this is a theory question. So they are saying when will this deferred revenue be recognized? This deferred revenue discount voucher will be recognized as revenue when customer purchases the goods in future or when this discount voucher expires, whichever comes early. So B for Bengaluru is the right answer over here. Okay. What is the nature of the Z liability? How will you account this discount voucher? So we'll account it as per Ind AS 115. Ind AS 115 we call this as contractual liability. That's all. So C for Chennai is the right answer for this particular MCQ. Pretty straightforward. Okay. Moving on to the next descriptive part. Now people, question number 6 is on consolidation. This is the only question I would say is actually good overall from this particular RTP. Pretty much everything else is manageable, but this is a good question. There are 2-3 points which is newly constructed in this particular question. So watch out for that. Easy only. Okay. Overall consolidation steps are very, very easy, but there are 2-3 points which makes this question little interesting. You need to pay attention. If you understand it, even this is also pretty straightforward question. Okay, so it's a CFS wala question. The balance sheet of M and N are given, but they are not on same date. They are on 2 different dates. That's the first bouncer or new point. M Limited ka balance sheet they have given as on 31st March 20X2. But N ka they have given on 31st December 20x1. Okay, M ka up to 31st March 20x2, N ka only 31st December 20x1. That means what? Straight away can you consolidate? No. For you to consolidate, the balance sheet has to be on the same date. So first what you have to do? You will have to get N ka data from 31st December to 31st March 20x2. Meaning 3 months extra transaction would have happened, January, February, March, that they have not considered. They will give you a summary. In the adjustment they will give, in these 3 months, few things happened. First, those 3 months transaction effects, you need to give it in balance sheet. Okay. Then you will get 31st March 20x2 ka data of N. And then only prepare the consolidated balance sheet. Okay, people. This 3 months ka transaction giving the effect, that is the crux or new adjustment in this particular problem. This, if you give it properly, consolidation is very, very easy over here because basic consolidation problem they have given. Hardly any adjustment is there. Okay, sir. But the crux is this 3 months count. Okay. All right, let's move forward. Property, plant and equipment given, no issues. Investment, 40,000 shares in N. So basically M has purchased shares of N. So looks like M is subsidiary, N is the, or rather M is the parent, N is the subsidiary. How many shares we have purchased? 40,000 shares M has purchased in N. Okay, not only that, one more. Check what is that? 1,000 debentures in N. This is not a new adjustment to us. We have done it, right? In last few RTPs and MTPs, this adjustment is there. This is like your mutual owings. That's all. For M, it's a financial asset. For N, it will be a financial liability. Knock it off. Okay. But investment will be shown usually at your cost price. Debenture may get reflected at your face value. Value will not change, right? Value will not match. The difference you account it in your retained earnings or other equity. That's all is fitting over here. This is your basic mutual owings like your debtor, creditor, bill receivable, bills payable cancellation. This also you need to cancel, but value will not match. The difference you'll adjust it in other equity. That's a crux. This is not a new adjustment. We have done. Okay. All right. Next, inventory. So don't worry about this comment what I've written. It's this 3 months ka effect that I brought in over here. I'll read the adjustment and then we'll take off this. So don't worry about this particular point right now. Only look at the main value of balance sheet. So you normal balance sheet given. If you just check N Limited, they have a 13% debentures. Same debentures only M had purchased. For M it's a financial asset. For N it's a financial liability. But value is same. No, here it is 150. Here it is 3 lakh. I mean balance 3 lakh minus 150 is retained earnings, sir. No. Right? We have purchased only 1,000 debentures, macha. Okay, and each debenture ka value is 100. That means what? So the total subsidiary has a debenture of 3 lakh. In that total face value, the debenture subsidiary has is 3 lakh. In that 1 lakh worth face value, we have purchased. Okay, at what value? 1,50,000. How 1 lakh? 1,000 into 100, which is 1 lakh. We have purchased 1 lakh face value of the debenture at 1,50,000. So subsidiary is showing the liability at 1 lakh. Parent is showing that as asset for 1.5 lakh. So the difference between these two is 50,000 that we'll have to adjust it in other equity or retained earnings over here. That's all this is wrong. Okay, sir. Mutual owings basically. Don't cancel fully. Right? Mutual owings means only transaction between parent and subsidiary. Parent and subsidiary transaction has happened only to the extent of this 1.5 and 1 lakh. Okay. All right. Next to look at the other things. Here also pretty common. Nothing much. Now let's come to the adjustment. That is where the major things are given. Okay. Now check on 5th January 20x2. Keep in mind N ka data they have given only till 31st December 20x1. January, February, March, 3 months ka transaction effects we need to give. So first they have given on 5th January, certain inventories of N Limited costing 20,000 were completely destroyed by fire. Subsidiary ka some 20,000 cost of inventory gone. So that means inventory value will reduce by how much? 20,000. Is there any insurance? Yeah, we are smart enough. We have taken an insurance. An insurance company has paid. We have already received money. How much? 75% of the claim. So what is the entry? We have to give the effect, okay? But I feel we'll just go through the entry so that the moment you know the entry, easy to give the effects in respective asset and respective liability, So though 20,000 inventory we have lost, full claim did we receive or only 75%? Only 75%. So 20,000 ka 75% is how much? 15,000. So the entry will be bank account debit 15,000. To inventory we have to reduce, right? To inventory 20,000. Balance 5,000 is loss. Okay. Now like this, each transaction we will read, go through the journal entry and This journal entry ka effect directly will give it in balance sheet. Now, because of this journal entry, what happened? Bank balance increased by 5,000. Where is our bank balance? Here. Okay. So subsidiary ka bank balance will not be 105. It will increase by 15. That's what I've written here. Okay. This is one. Next though, inventory reduced by 20, loss by fire, SPL. So because of this retained earnings, we saw retained earnings in balance sheet, right? Retained earnings will reduce by 5. Inventory will reduce by 20. Given now. Retained earnings reduced by 5. Inventory will reduce by 20. This is your inventory. It will reduce by 20. As an NVC will tick off. That's all. Then you will get the revised value of the inventory. Take that and add it with the parent ka respective components. Consolidated balance sheet done. That is all we have to do. Like this, they have given 2-3 transactions. You need to give the effect. Okay, sir. Easy. All right. Next is what? On 20th January. Okay, same. M Limited, parent, has sold the goods to N, costing 1,50,000 at an invoice price of cost plus 20%. Parent has sold goods to subsidiary. The cost of the goods is 150, but did parent sell it at cost? No, they added a profit markup of 20%. Profit is 20% on cost only. So calculate 1,50,000 ka 20%. 1,50,000 ka 20% is 30,000. That means parent has sold goods to subsidiary for 1,80,000. Okay. Now, parent ka books are anyway prepared till 31st March. So, parent has accounted everything. No problem. Because parent ka balance sheet is as on 31st March. So, whatever sale parent made, they have already recorded in their balance sheet. But subsidiary ka data only is till 31st December. Now, this particular transaction ka effect, we need to give it only in subsidiary books. For a parent, it is a sale means for subsidiary, it will be purchase. What's the entry for purchase? Purchase account debit to your financial liability creditor. So when you purchase, inventory value will increase, right? Correct. So that means effectively, if you have to say for our understanding, we can write the entry inventory account debit to M Limited financial liability because this is a creditor. M is a creditor for N. All this entry, keep in mind, we are passing in subsidiary books, N Limited. Okay, every entry. So the entry will be purchase account debit. How much? Parent sold for 180 means and subsidiary will buy for 180. So purchase inventory will increase by 180. M Limited financial liability creditor will increase by 180 as well because we have to pay. So check inventory increase 180, financial liability increase 180 here. This is your financial liability trade payable will increase by 180. Sorted. Similarly, inventory also will increase by 180 of subsidiary. I've written here add 180. Okay, that's it. All right. So what about unrealized profit? That we will do in consolidation separate working. Don't worry about that for the time being. I'll come to that. Yes, you are right. Because parent has sold goods at a profit, there is unrealized profit element here. We need to eliminate. That is a consolidation adjustment. Let's do that later. First, we'll give this 3 months ka effect transaction. Then we will go through the consolidation adjustment in one. Okay. 2 consolidation adjustment we already found now. One is your mutual owings for debenture cancellation, 50,000. Another one is unrealized profit, parent making a sale to subsidiary. That separate working note we will put and then proceed. Okay. All right. 50% of this goods, read this line carefully. M has sold goods worth 180. Cost was 150. We added 20% of profit markup and sold it for 180. Now they're saying 50% of those goods were resold by N to M. They're playing, they're kids. First M is selling to N, N is selling it back. It's not returns. It's not return. Okay. So now after buying the goods from the parent, subsidiary sold the same goods back to parent. What joy? We don't know. We can't question the question. 50% of these goods were resold by N to M Limited within 31st March. So this transaction also has happened within 31st March. Okay. 50%. Keep that in mind. These goods were then sold by M to a third party. So N sold 50% back to M and is parent holding these goods? No, these goods were sold off to the third party. That means on this, we don't have to worry about unrealized profit. Goods are not there. Unrealized profit means profit element included in inventory. So if parent subsidiary have done any transaction among themselves and if those transaction has happened at a selling price and if any profit is included in closing stock, we need to eliminate. That is what is unrealized profit. Unrealized profit ka very meaning is profit included in stock. Now subsidiary N sold the goods to M, parent. And what did parent do? Parent sold off these goods to a third party. Within what day? 31st March. So these goods are not within the group. These goods have gone out of the group. So on this, we don't have to worry about unrealized profit. Parent has sold the goods to subsidiary, full value 180. On that, we may have to worry. But whatever goods subsidiary sold it back to the parent, On that, we don't have to worry about unrealized profit because those goods are not within the group. It has left the group. Okay, people. If parent had not sold this goods to a third party, if they had maintained, means then you have to remove unrealized profit on that also. Okay. In that case, two unrealized profit will come. Both the questions we have solved in our regular class. When parent sells the goods to subsidiary or subsidiary to parent, how to calculate, where to eliminate, we have seen. So that's the same adjustment. But here, on this end to subsidiary to parent wala sale, unrealized profit, we don't have to worry because that goods are not within the group. Okay. On 31st March, so entry, 1 second. Sir, I can't pass the entry. Subsidiary sold goods to parent. At what value given now? Parent sold goods to subsidiary at 180. Value was given, so I passed the entry here. At what value subsidiary sold this goods back to parent? That they have not given. So far not told. So let's read a little ahead. As on 31st March, N subsidiary owes 160 to M Limited. That's the keyword. That's a clue. As at the end of the year, 31st March, subsidiary N still owes 60,000 to M in respect of these goods. 1 second, hang on. Subsidiary purchased the goods from parent for how much value? 180. That means subsidiary has to pay the parent 180. But is 180 payable at the end of the year? No, 180 is not payable at the end of the year. How much is that? 60. Means what? So 1,20,000 already paid, sir. Already paid Allah. Subsidiary sold the goods back to the parent. No. Subsidiary sold goods to the parent. No. That value, at what value subsidiary made the sale to parent was not given. That is what? That is 120. Arrived as balancing figure. How? Subsidiary had to pay the parent how much? 1,80,000. On when? 20th January. But same on 31st March, if you check, payable amount is only 60. Instead of 180, it is only 60. Right? That means what? Balance is what? 180 minus 60 is 120. That is not paid. That 120 is not paid. Subsidiary made a sale to parent. No. The sale was made at 1,20,000. So what's the journal entry for sales? Subsidiary has to pass. They have not done, no? Because this transaction happened on 28th January something. Parent ka data is only given till 31st December. So the entry will be debtors to sale. Debtors to sale. But I want to give its effect. So when you sell the goods, inventory will reduce. So I will pass the entry debtors to inventory. Because when you purchase, inventory value increases. When you sell, inventory value reduces. Entry you don't need to pass in exam. I've just written it so that we can understand better. So financial at the debtor. How much did we sell the value? We already know. Now we will not pay to the parent 180. We have to pay only 60. So we have sold the goods to the parent for 1,20,000. But Punyatma, Prospati, don't credit inventory by 120. Right? Inventory is shown at cost price, right? So you will reduce at cost price. How much goods subsidiary sold to the parent? Only 50%. For 100%, the value was 1,80,000. 100% because subsidiary purchase, no? Subsidiary purchase 100% of the goods at 180. How much was sold? Only 50%. That means you will credit your inventory not at 120 but at 90. Why? 1,80,000 is the value for 100%. For 50%, what is the cost? Inventory won't be reduced at selling price. Inventory will be reduced at cost price. So for 100% the value is 180 means for 50% value will be half, which is 90,000. Okay, fine people. I'm expressing this in entry in inventory. So did subsidiary make any profit due to this transaction? Yeah. The value is 90. Subsidiary sold it for 120 means they made a profit of 30,000. Now this entry ka effect we have to push it into the balance sheet. Why? Because this particular transaction happened within that 3 months. January, February, March. And subsidiary ka data is only given till 31st December. Now push the effect. What is that? M Limited. M is already a creditor for subsidiary. Now you are debiting creditor by how much? 120. So balance will reduce. Because we will not pay 180 anymore. No, we have to pay only 60. I have added 180 here already. If you want, you can do 180 minus 120 and take direct number 60. Since I'm going transaction by transaction, I've already added 180. Now, you can think of it as since we sold, we'll not pay the creditor 180 anymore. 120 we have debited. So 120 value of this financial liability creditor will reduce by 120 because we sold the goods. So in a way, 120 already settled. So this is done. Next, inventory will reduce by 90. SPL you have credited. So P&L already has credit balance. Again, if you credit, balance will increase. But in balance sheet, we don't show SPL, we show retained earnings. So inventory reduced by 90, retained earnings increased by 30. Inventory reduced by 90, retained earnings increased by 30. That's easy. This is the crux of this question. The second adjustment is there, no entry. This is one of the highlight, you could say, of this particular question. Rest everything is false. Okay, next what is there? Pre-acquisition profit. Now all these are consolidation adjustment, people. Fine. Everything is done. Okay, now we can start with our normal consolidation adjustment. Maybe before that, first I'll quickly run through the consolidation adjustment. Now, pre-acquisition profit of N Limited on the date of acquisition, they've only given, because we need to know how much profit is pre and post, no, for allocation. Pre-portion of subsidiary ka profit, they've only given 75. NCI is not valued under PSNA basis. We are valuing under fair value method. Okay. And fair value of N Limited as on the date of acquisition is 18 rupees per share. Per share. Okay. Now we need to find out the value. I think we can find. We'll figure it out. Prepare consolidated balance sheet. Done. Okay. Now we'll start with our working. Right. Before our normal working, two working notes we'll prepare. One is that debenture ka cancellation. Value is not same. No. We purchased only 1000 debentures. Each ka face value is 100. Subsidiary is showing that debenture in their books at 1 lakh, but parent has purchased for 1,50,000. So that difference we'll have to adjust in other equity. That's the first working note I'll prepare it. Check. Financial investment for parent is 1,50,000, but the same thing subsidiary is showing as financial liability in their books 1 lakh. How? 1000 debentures purchased, 1000 ka 100, 1 lakh. So the difference 50,000 we'll adjust in other equity. Clear, people? So basically one asset, if you wanted an entry. So because some students will say, sir, this 50,000 we have to add or we have to minus. We are confused. If that is a confusion for you, you can pass entry. Now financial asset we need to cancel. Asset has debit balance. How do you cancel? You credit it. To financial asset you will credit by 1,50,000. You also need to cancel financial liability. You also need to cancel financial liability. Financial liability has credit balance. How do you cancel? Debit it. So FL you will debit by 1,50,000. Okay, FL rather you will debit only by 1 lakh rather amount, sorry. FL you will cancel by debiting at 1 lakh. FA you will cancel by crediting at 150. Journal entry not matching. 50,000 is a balancing figure which you will adjust in your other equity. Other equity you are debiting means other equity is a reserve. No, it has credit balance. When you debit, its balance will reduce. So this 50,000 you'll have to reduce in your last working note. If you remember, we used to prepare other equity. Either you can write working note number 7, or we used to call it as note number 1 or 2 in our regular class. You can call it there. We have to reduce 50,000. That's what is done here. Clear? Okay. This is one. Next, parent has sold goods to subsidiary. Right? Now, how much? 150 was a cost, but we sold it at 180. Cost was 150, but we sold it for 180. That means how much is the profit? Profit is 30,000. Parent sold goods to subsidiary. In that, what happened? 50% of these goods, subsidiary sold it back to the parent. And is parent having that goods? No, parent sold it to a third party. So that 50% is gone. But what about other 50%? Other 50% parent sold to subsidiary. So subsidiary still has that. So that means if parent sold for 180 means subsidiary purchased for 180 and purchases will be shown in inventory. So currently subsidiary is showing their inventory at 180. So there is some profit included there. Eliminate the unrealized profit. So how much eliminates? 30,000. Don't eliminate 30. 100% of the goods subsidiary has. No. Of the goods parent to sold to subsidiary, subsidiary sold back 50% and parent sold it to a third party. So how much goods are really remaining with subsidiary? Only 50%. So you have to eliminate only 50% of the total profit, which is how much? 13,000 or rather 15,000. 30 ka 50%, which is 15,000. You can calculate whichever way you want. I've just showed you the easy way. Okay. So that's what I put up as the next working note. Unrealized profit on the sale of goods made by the parent to the subsidiary company. Total goods sold 1,80,000. Full goods are there only 50%. So goods remaining in the group is only 50%. So 180 ka 50% is 90,000. Only on 90,000 you need to eliminate. But 90,000 is a selling price. Profit was expressed on cost. If cost is 100 means profit is 20% on cost, which is 20. So selling price will be 120. So this 90,000 represents 120. We want profit, which represents 20. So you can do 90,000 into 20 by 120. That is one way to get it. You'll get 15,000. Or simply say, parent made a profit of 30,000. Alright, only 50% goods is remaining. 30,000 ka 50% is 15,000. Like that also. Both the ways I've shown, whichever you're comfortable, you can take it. So this, now onwards, easy or normal consolidation working notes. What is the next step? Fair value of net assets of subsidiary on the date of control. How do you get that? Equity and other equity. There is no fair value adjustments, nothing. What is equity share capital of subsidiary company, people? 5 lakh. Take that. So I've taken, right? And then the pre-acquisition profit on the date of acquisition, how much ever other equity subsidiary has. That they've only given in the question 75. So there is no fair value adjustment. So net assets on the date of control will be addition of these two, 5,75,000. Easy, right? Next, goodwill working note. For goodwill, we take PC. PC is nothing but your amount paid. So don't take debenture ka value, only equity shares. For equity shares, parent paid how much? This debenture is a mutual owing, it will get cancelled, right? So now goodwill is considered or calculated only by using equity shares. For equity shares, how much did the parent pay? 8 lakh. So PC is 8 lakh. But mind you, if you want, here they have given how many shares as equity shares parent purchased? 40,000. What is share capital of subsidiary? 5 lakh. And each share ka face value how much? 10 rupees. That means how many shares subsidiary has? 50,000 shares. 5 lakh divided by 10, your subsidiary has 50,000 shares. In that 50, parent has 40,000. So what is parent ka shareholding percentage? If you want that also, you can put as a working note. Out of 50, parent is owning 40. 40 divided by 50 is 80%. I have shown it here. So for 80%, subsidiary, a parent has paid a PC of 8 lakh. Okay. That means NCI has 20%. How many shares NCI has? Totally subsidiary has 50,000. In that, parent has purchased 40,000 means NCI has a share of 10,000 shares. And the fair value of one share of NCI, they have given here to be 18 rupees. Given. One share ka fair value 18, 10,000 shares, how much? 1,80,000. Right? And reduce fair value of net assets, we already got 575. We'll get the goodwill of 4,05,000. From now onwards, very easy question. No much change at all. Working note number 4 done. Same format I'm trying to put across as we do it in our regular class. Next is analysis of post-acquisition profit of subsidiary company. Okay. What is subsidiary ka retained earnings they've given? Subsidiary ka retained earnings given is 2,05,000. There's a number given. Now don't take directly this. There's some adjustment. No, this is the retained earnings on 31st December. We want basically retained earnings closing balance on 31st March. So that 3 months transaction ka effect was there. Yeah, due to that 3 months, any effect was there in retained earnings. Yeah, here check 5,000 and 3,000. This 5,000 was some subsidiary ka stock got lost by fire and 5,000 loss was suffered. And this 30,000 was subsidiary sold goods to parent and made a profit of 30,000. So minus this, add this. That effective. So retained earnings balance of subsidiary is not 2,05,000. It is 2,05,000 minus 5,000 plus 30,000. Check. Minus 5, 30,000. This is loss by fire and this is a profit made by subsidiary when they sold goods to parent. Okay. This way you will get closing balance of retained earnings. This is a total retained earnings. In that pre-acquisition retained earnings, they have only given in the question is 75. So this is the retained earnings of closing balance. In this, if 75 is pre means balance will be post. Hence, pre-acquisition profit, what was given to us. This is given again in the question that we eliminated. So this is the, once again, this is the closing balance of retained earnings. Now, after giving that 3 months ka effect, retained earnings ka closing balance will be this. Okay, basically 2,30,000. In that 230, if 75 is pre means balance 155 will be post. That's all. Now, what do you do for post-acquisition profit? Distribute among the parent and NCI in their shareholding percentage. Here it is 80%, 20%, right? So 80-20 may you distribute and you got that. Okay. Then NCI ka working note. Fair value of NCI on the date of control was 1,80,000. To that you add what? Post-acquisition profit of NCI, which is 31,000. The same. Here onwards, I don't think so. You need my help at all. So you will get the NCI ka closing balance. Then other equity. Other equity what? Other equity means only parent ka. What is the parent ka other equity or retained earnings people? 4,50,000. So take that number. You can assume that 450 either as an opening balance or current year ka, your call. Okay. Here I have assumed opening balance was 0. Total comprehensive income TCA is 4,50,000. Done now. Then add post acquisition of subsidiary ka share, which is what here 1,24,000. Add that. Then two things. One, no. Debentures ka mutual owing cancellation 50,000. Other equity you have to debit. So balance you have to reduce. 50,000 you have to reduce. Here already done. Then unrealized profit. Unrealized profit is how much? 15,000. Unrealized profit you need to eliminate. One profit you need to eliminate. So obviously balance you need to reduce because parent made this profit now. So 15,000 profit you need to eliminate from the parent ka other equity. So you will get the closing balance of other equity. Now simply take this data and prepare consolidated balance sheet. Straightforward effect. Okay. In fact, this only is your balance sheet. All this plus minus if you do only balance sheet. Okay. Once again, we'll quickly go through if you want. PP, no adjustments. Add these two. 650 plus 405. Done. Then Investment in equity shares will not come. No. Instead of that, goodwill will come. Investment debentures as a mutual owing got cancelled. So how much was the goodwill value? Goodwill value we got it as 405 shown over here. Okay. So these two will not come. Instead of this goodwill came, this is a mutual owing got eliminated. So 150 minus 150 is 0. Okay. Then inventory. This only adjustment. Parent got 2 lakh plus subsidiary ka given value 350, but 3 months ka effect you need to give. Okay. So 2 lakh plus 350 minus 20. Okay. This minus 20 is for goods lost by subsidiary due to that fire. And then this 180 we will add because subsidiary purchased the goods from parent. 180 will increase. Then this 90 is because subsidiary sold goods to parent worth 90, half of these goods. So it reduced. Then unrealized profit is there. No? Unrealized profit you have to reduce from closing stock, right? This is not from subsidiary ka closing stock. You have to reduce. Parent has sold goods to subsidiary. So yeah, you have to reduce 15,000. This is your unrealized profit. So do this plus minus 2 lakh plus 350 minus 20 plus 180 minus 90 minus 50. That's what I've written here. Then you will get your inventory ka value 6 lakh 5,000. Easy. Yeah. Then what? Trade receivables 150 plus 65. Okay, people, and don't forget mutual owings, right? They told subsidiary still has to pay to the parent how much? 60,000. For subsidiary, it is creditor, means for parent, it's a debtor. So take the value and minus 60,000 you do. Mutual owings. This was given an adjustment. So 150 plus 265 minus mutual owing of 60, that will be the value. Okay. Then cash ka 80 plus 105, insurance claim we received for 15,000. No? So add 80 plus 105 plus insurance claim of 15,000. This will be the value. Total asset will match, will be at 26 lakh 20,000. Then equity. Equity of only parent will come. Subsidiary will not come. That got adjusted, and instead of that goodwill and all we have. So equity is 10 lakh. Other equity we have it from our working note. Equity 10 lakh. Other equity balance is 5 lakh 9,000. Then NCI. What is the NCI balance? 2 lakh 11,000. Take that in shoe. Correct. Then non-current liability of subsidiary, they have debentures. In that there was a mutual owings for 1 lakh, right? So from 3 lakh, eliminate mutual owings for 1 lakh. 1,000 debentures. 1,000 debentures of, because parent is owning 1,000 debentures, no? Each ka value 100. So 1,000 into 100, 1 lakh you will reduce from your financial liability. So 3 lakh minus 1 lakh will be 2 lakh. So that will be the final value. Parent does not have any FL, so this is the value. Then what else is there? Trade payable 380 plus 80 plus 180. This for your goods purchased and goods sold. 180 minus 120, same transaction. And also don't forget to eliminate mutual owings of 60. Okay, so 380 plus 80 plus 180 minus 20 minus mutual owing of 60. This will be the value. The last thing is your other liability, no change. 2 lakh plus 40, same value. 2 lakh 40,000 will come. Liability also matched at 26 lakh 20,000. That's all is this particular balance. Consolidation workings are very, very simple over here. Okay. Other than that, debenture ka mutual owing, unrealized profit though will be there in every problem. So we are comfortable with that, right? Only that 3 months ka transaction effect, you need to give it properly. That if you do it, this is a very, very straightforward consolidation question, but still a different framing. So yeah, once better to review it. Okay, now onwards, all 5 minutes question. Okay, most of them are. Okay, 1 minute. Check this. This is an Ind AS 12 question. X has 2 wholly owned subsidiaries A and B. X is a parent. They have 2 subsidiaries A and B, fully owned subsidiary. Company had acquired 100% equity of these companies on 1st April. That's your date of control. Investment was as follows. So on 1st April when we purchased, X paid 5 lakh and 5 lakh to acquire both the subsidiary ka value. So after you get the control, we'll show subsidiary ka net asset and CFS. So profit or loss for the next 3 years of subsidiary, both the subsidiaries they've given. Okay, so all your post-acquisition profits. Done. As on 31st March 20x4, date of control was 1st April 20x1. After that, 3 years data they have given. And then they said on 31st March 20x4, in standalone financial statement of X, standalone SFS, the future projection of company A Limited going negative, the entire investment was impaired by 5 lakh. Full investment of A Limited, they're saying is impaired. So investment value 0. The same was disallowed under income tax ka X ka jurisdiction. Further, in consolidated financial statement of XO, the net asset in relation was also fully impaired. Okay. Okay. So first we'll read the requirement. in CFS, you need to do all this in CFS. They're asking, would you create DTA DTL with respect to A? Would you again create DTA DTL with respect to B? In CFS, they're asking because of this. No, you create CFS. I mean, on various components, we'll create deferred tax asset, deferred tax liability. With respect to this investment, will you create DTA DTL is what they're asking. First of all, people, investment in subsidiary will only come in standalone financial statement. Because in consolidated financial statement, investment will get eliminated. What will come? Rather, instead of investment, we show subsidiary ka net assets, we show NCI, we show goodwill, etc., etc. So basically, instead of investment, you could say net asset comes as a substitute, right? Okay. So on that net assets, we compare, no, because in consolidation, we take fair value of net assets. We take fair value of net assets. That will not match with the tax base. Because in consolidated financial statement, fair value of net assets becomes carrying amount. But tax base will be all this fair value adjustment is there only in accounts. It is not there in tax. So there will be a mismatch. So carrying amount and tax base will not match. On this, will you create DTA? DTL is what they're asking. First, we will calculate. Actually, you can write one liner. But first, we will calculate. What is that? Okay, first, what is subsidiary carrying amount of, I'm not written investment because investment will not come in CFS. Instead of that, net assets of subsidiary will come. How much value? So net assets of subsidiary company will not be 5 lakh because you're making profits. No, when you make profits, obviously net assets will increase. When you make loss, net assets will reduce. So 50,000, 5 lakh minus 50 minus 60 minus 70 you will get the net assets. How much? 3,20,000 I've written here. 5 lakh minus 50 is 450. 450 minus 60 is 390. 390 minus 70 is 3,20,000. This is the value. But I've not written 320. I've written nil. Why? Because they said in the question this is fully impaired. In consolidated financial statement, net assets in relation to A was fully impaired. It's fully impaired means carrying amount of net asset in CFS relating to subsidiary A is 0 because it is fully impaired. Okay, but this impairment was disallowed in A Limited ka jurisdiction. Okay, this was the saying it's not there. This adjustment, impairment adjustment is not there in tax base. I mean, as per tax base may this also is not there. As per tax, the value is 5 lakh because you purchased the investment for 5 lakh. So as per the tax record, tax base is 5 lakh. Carrying amount of, there's a net asset. So think of it as an asset, right? So right, because net asset, if it is positive means asset value is greater than liability. Because DTA, DTL we create by keeping asset liability in mind, right? So net asset, you can say it's an asset, right? So asset value is lesser than tax base. We have already studied. If asset ka value is greater than tax base, then it will be a taxable timing difference. On that we will create DTL. If asset value is lesser than tax base, it creates deductible timing difference. On that we will create DTA. Here it is lesser. So difference 5 lakh is a deductible timing difference on which we need to create. I'm not saying create. I'm saying we may have to create a DTA of how much? Tax rate in this problem not given. We will not create DTA, DTL on the difference. We take the difference and multiply tax rate. Tax rate not given. So I'll only say difference is 5 lakh. On this difference, it leads raised to DTA. How much? Tax rate not available, we cannot create. Same drama for B. We purchased it for 5 lakh, but here B is profit. So net asset value will be 5 lakh plus 50,000, 550. 550 plus 60 will be 610. 610 plus 70 is 680. So net asset, the carrying amount of net assets relating to subsidiary B is 680. That is not impaired. Here they have not said anything here. Okay, people? Alright. What about tax base? Sir, all this adjustment is there only in accounts. As per tax record is concerned, tax base is still the investment value, which is what? We purchased the investment for 5 lakh. So carrying amount of net asset 680. Tax base is 5 lakh. So what is the difference? 180. Carrying amount is greater than tax base now. When carrying amount is greater than tax base, it creates taxable timing difference, which gives rise to DTL. Tax rate not given, so I cannot find out the value. This is the value. Okay. So B on 31st March 2004, B has excess earnings available, which would be transferred to holding company in future, but it cannot be repatriated in a tax-free manner. So whatever profits subsidiary has made, it can be given back. Repatriation means giving back. It can be given back to subsidiary, but when they give back, it will not be tax-free. On that repatriation or on that transfer, tax will get attracted. How it will be repatriated? Subsidiary can give the dividend to parent. No? So that way money can be routed back to the parent. But when this routing happens, it will not be a tax-free adjustment on this tax provisions will get attracted. That's fine. Okay. Now, whether DTA, DTL will be recognized in the books of CFS for both they're asking. Assume that no indexation benefit is there. If you get indexation benefit, then tax base will not be this people. Due to indexation benefit, tax base will increase. So here they're saying both the case में taxation benefit is not available. Okay. So now this is the DTA or DTL we may have to create. How much we can't say because tax rate is missing. But people, there is a provision. What provision? We have studied. We will create investment on the investment in subsidiary, associate, joint venture. We will create DTA. As a thumb rule, we will create DTA or DTL. But no DTA, DTL is required if two conditions are satisfied. We had studied. Okay, one, the investor is able to control the reversal of timing difference, and this reversal of timing difference is not expected to happen in the foreseeable future, right? So basically, if these two conditions happens, then no DTA, DTL is required. I had told these two conditions will get satisfied with respect to subsidiary ka investment. So on subsidiary ka investment, basically will not create DTA, DTL because these two conditions usually will get satisfied. So here, don't write one-liner answer, write all this and finally say, no DTA, DTL is required because these two conditions get satisfied. What is this? We have done 2-3 questions in regular class on this. Is once again saying investor is able to control the reversal of timing difference. People, this difference will get sorted when the parent will be able to control that. So this difference will get sorted when subsidiary declares a dividend. Because when subsidiary makes the profit, net asset will increase. But when subsidiary declares a dividend, right, net asset will reduce. So by declaring the dividend, okay, by declaring the dividend, these differences will get sorted. And who decides subsidiary or dividend policy? Obviously parent. So in case of parent subsidiary relationship, the parent will be able to control the reversal of timing difference. And the reversal is not expected to happen over foreseeable future. The parent doesn't want to reverse this soon. Okay, this reversal, the parent is expecting that it will go on forever. If both of these conditions are satisfied, then we don't have to create. So in case of subsidiary parent relationship, both the conditions will get satisfied. Hence, on investment in subsidiary, you don't have to create DTA, DTL. But I told in investment with respect to associate or joint venture, create DTA, DTL. We have question also, provision also on this. It's not a new thing to us. Okay, we have studied. Same thing asked in a different format. Yes, people, that's all is about this question. So I think there was one more question which I missed too. This is question number 7. Okay, 6th done, 8th done, 7th was missed out. Here they asked a total comprehensive income, TCI. So how do you get TCI? SPL plus OCI put together. SPL and OCI items if you add, total put together becomes total comprehensive income. So it's just a classification question. What components are SPL? What components are OCI? You need to categorize them properly, total them up and you'll get TCI. That's all it is. It's pure category question. Profit from normal operation is OCI. Yeah? Oh, it is SPL item. Remeasurement gain with respect to net benefit plan as per Ind AS 19. These are all OCI items. So yes, OCI NR, non-reclassifiable or recyclable OCI. So just don't write OCI. Tell which are reclassifiable or which are non-reclassifiable. This is OCI NR. All this we have done in our regular class. Yeah, nothing is new here. Gain on with respect to translation of foreign operation. Foreign operation is an OCI R, reclassifiable OCI, FCTR, right? So we've done question. The same question or similar type we have done. It's available. So this is an OCI R wala item. Revaluation gain on PP. This is OCI NR. But I think here in the RTP solution there is a typo. ICAI is shown it as OCI R by mistake. Okay, but the right answer should be OCI NR. That's a typo. They'll correct it. Don't worry. Then fair value changes on financial asset. So when it comes to changes in financial asset, answer could be anything. Because financial asset, if you can measure it at FVTPL, you can measure it at FVT OCI, correct? No. So you have option. If you measure it at FVTPL, then the gain loss will go to SPL. So debt financial instrument is a OCI R item. On equity option, if you have chosen an irrevocable option of opting for FVT OCI, then it's OCI NR item. So actually it could be anything, right? So or you can go for ACM method also. So here it's a little ambiguous. They should have given a little more data. Because they just told financial asset, they did not tell how it is measured, which method is adopted. Because if it's irrevocable, it could be OCI NR also. But on debt financial assets, so if you go for FVT OCI, that's a OCI R item. If you go for FVTPL item, then it is an SPL item. So based on the valuation method adopted, the whole thing can change. But here ICAI has assumed that this is OCI R. So if the same question comes in exam, you also, I suggest, make the same assumption. But other cases are also permissible over here. But let's not question the question. So if they don't give any information, if the same thing comes, we will also put it as OCI R. That's all it is. So these are OCI item, this is SPR item. All if you add, you'll get the TCA. Just categorize and add them. That's all. This is question. Faltu. Maybe 2 marker question. That's all. Done, people. Next, ninth one. Okay, there's also a repeat wala question. We have a similar question. Quickly, I'll run through maybe. Not the exact same question, but a similar one is available. S finance construction of qualifying asset with an intercompany loan taken from parent. Subsidiary has taken a loan from parent and they're constructing a qualifying asset. Fair enough. That means subsidiary has borrowing also. They have qualifying asset also. So in subsidiary books, borrowing cost you can capitalize. So how much ever interest subsidiary is paying to the parent, that much extent you can capitalize because both are there. No? Borrowing is there, right? And qualifying asset is also there. So borrowing cost capital. Here you just need to tell in subsidiary, parent and CA. In SFS of subsidiary, SFS of parent and in CFS, is borrowing cost capitalization allowed or not? That's all. It's a theory question. So subsidiary has borrowing as well as qualifying asset. So to the extent of borrowing cost that they are paying, we can capitalize. Okay. Now what about parent? That's what you need to answer. In parent books, and how did the parent arrange the money? 1 minute, read this line question again. S finance construction of qualifying asset with an intercompany loan taken from parent on which 7% interest is payable. So S is giving to the parent 7% interest. Parent in turn has obtained the said loan from a bank at the same interest rate. Parent has taken the loan from bank and given it to subsidiary. So in parent books, there is borrowing. Loan is there because they have taken it from bank. But does parent have any qualifying asset? No. Who has it? Subsidiary. So parent has borrowing, but parent does not have any qualifying asset. So borrowing cost capitalization in parent books is not permitted because qualifying asset does not exist. What about consolidated financial statement? That's what you need to answer. When you think from a group perspective, in the group's perspective, there is loan also, right? And there is borrowing cost also. So you can capitalize. But keep in mind, here, yeah, borrowing is also there. Once again, qualifying asset is there, borrowing is also there. So borrowing cost capitalization is allowed at what rate? 7%. What is the 7%? Now, people, there could be a case where the parent can take a loan from bank. Oh, okay, let's say 7%. Parent has taken a loan from bank at 7%. But same loan parent gave to subsidiary by charging 12%. Getting the scenario? Parent has, this is not there. Okay, answer is this only. This is just an if case I'm discussing. Another case. Okay, this is not there in this problem. Problem ends here. Okay, fair enough. In consolidated financial statement, borrowing is also there. Qualifying asset is also there. So borrowing cost capitalization is permitted. Question over. Now one more case is, visualize this. Parent has taken a loan from, let's say, SBI at 7%. After taking loan, parent gave the loan to subsidiary, not at 7%, but say at 12%. In that case, what you will do? In the CFS, okay, you should not capitalize borrowing cost to the extent of 12%. Loan originally was taken at what rate? 7%. From the bank, parent took the loan at 7 now, So you will capitalize still the borrowing cost in CFS at 7% only, not at 12%. Okay, because parent has taken original loan from the bank only at 7. So watch out, this is not there here. In case they bring in this, so you need to say that still capitalization will be 7% only will be considered for capitalization purpose. That's one. 10th one is a repeat question. It is there. Okay, maybe quickly I'll run through. A Limited has incurred 1 lakh on research expenditure. We don't have to do anything. Research expenditure we already know straight away goes off to SPL. Okay. B purchases research project including certain patents that has been registered by A for 1,50,000. Now people, if you remember, right, if company is doing any research, that research phase expenditure goes off to P&L. But if you have purchased research, you can show it as an intangible asset. So now here B has purchased A Limited. Maybe it's a business combination wala scenario. B has acquired A. A was already doing a research, and now B has acquired A means all A ka data now belongs to B also. So hence B has purchased certain research by paying how much? 1,50,000. Since this is a purchased research, can B show it as an intangible asset in their SFS? Yes, it's a purchased research, not the self-conducted one. So and B has shown this as an intangible asset in their books. Yeah, it's a purchased research. You can show it as intangible asset. So the treatment given by B Limited is correct. A transferred this to P&L. That is also correct. Since B has purchased by research by paying 150, B showed it as an intangible asset. That is also an appropriate or correct treatment. Subsequently, B incurs 2 lakh of expenditure on completing the research. B purchased the research. After purchasing, B is continuing the research on their own. Now, this 2 lakh is purchase research. No, this is the normal research expenditure B is incurring. So, Ind AS 38 says normal research expenditure, you have to transfer it to P&L. So, now this 2 lakh, it's not purchased amount, hence it goes off to SPL. Okay. Now B incurs further 3 lakh rupees to bring the product to a stage where conditions for recognizing development cost of internally generated intangible assets are met. Now people, we already know internally generated intangible assets are categorized into research phase and development phase. Research phase expenditure goes off to P&L. Development phase expenditure can be capitalized provided TIFRC is satisfied. Right. So now B is saying they spent another 3 lakh rupees to satisfy TIFRC. To reach that TIFRC condition, that's what they're saying. Check. It incurs further 3 lakh rupees to bring the product to a stage where conditions for recognizing the development cost of internally generated intangible assets are met. In order to reach this TIFRC stage, B incurred 3 lakh. Sir, you will capitalize development phase expenditure after TIFRC is satisfied, not before that. So this 3 lakh is incurred to reach TIFRC. So hence this 3 lakh also will go off to SPL. After the stage, if further development cost is incurred, B can capitalize, okay, as a development phase expenditure. That's what they're saying here. Further cost of 1 million as in 10 lakh are incurred to bring the product into condition where it is ready for use as the management wants. Yes. Now TIFRC is already met. Now further development cost incurred is 10 lakh. This can be capitalized? Yes, this can be capitalized. Therefore, totally how much got capitalized? This 10 lakh plus purchase the research of 1.5 lakh. So totally it will be 11.5 lakh. So in BCA books, this intangible asset will get reflected at 11.5 lakhs. Okay. They've given another 2 lakh we have incurred for marketing purpose. Sir, marketing purpose and all will not even bother. Right. We already know any sort of promotion expenditure, marketing expenditure will not be capitalized. It will go off to SPL. So basically the value at which this intangible asset will get reflected in BCA books is this purchase research of 150 and development phase expenditure incurred after TIFRC, which is 1 million or 10 lakh. So 10 lakh plus 1.5 lakh is 11.5 lakh. That's all his answer. But when it comes, you need to write the provision. Research phase expenditure goes off to P&L. Development phase expenditure can be capitalized if TIFRC is satisfied. Call out the TIFRC and then give the conclusion. Now, all that we have anyway done. I'm just quickly telling you the main fine prints of this question, because I know that all of this you will go through on the day of examination. Now, I don't want to take you through all the provisions. Provisions you already know. Yeah. All right. Next is 11th question, financial instrument wala question. One adjustment is good. It's new, you could say, but still I think you can manage this easy only. On 1st April 2XX0, we don't know what is that XX. You can maybe keep it as 1 or you can keep it as 0. We don't know, right? It's fine. On 1st April 2XX0, ZXCO originates 10-year 6% 1 lakh loan. Now, when you say originates, that is loan taken or loan given is the question that can arise. Because if it is loan taken, it's a financial liability. Loan given will become financial asset. Read the data. But loan amount we know 1 lakh. Actual interest rate is 6%. The loan carries annual interest rate 6%, payable at the end of the year. The loan is repayable at par at the end of year 10. Interest you have to pay every year 6%. Loan you will repay at the end of 10th year. Bullet repayment we are doing. Fine. ZX charges. Sir, ZX is the company they said is originating the loan, and ZX is charging, they are saying, from the borrower. I mean, ZX is charging something from the borrower means ZX is not taking the loan. ZX is rather giving the loan, because we are charging the borrower. So we are collecting something from the borrower means we are not the borrower. Other party is the borrower. We are giving the loan. So it's a loan given, meaning financial asset that we have concluded. Okay. So what did we collect? Z charges 3,000 rupees non-cancelable origination fees to the borrower. Okay. Now don't say this is transaction cost. Transaction cost is something which we incur. Here we are not incurring. This is not an expense. This is via collection. Okay. But this also should be adjusted from the financial asset ka balance, because all this is happening on the day one, right? So adjust this also. So what is the entry for this? If you want to think for financial asset loan given, what is the journal entry? Financial asset loan given account debit. Financial asset loan given account debit 1 lakh to bank account. Yes, sir. Assuming the transaction happened at the market price. So 1 lakh. Okay. Now this 3,000 rupees we are paying or we're collecting from borrower? We are collecting. So the journal entry will be bank account debit, or don't transfer this to P&L. This will be adjusted from financial asset only. How much? 3,000. Bank to FA is the entry. Okay. All right. Then it also incurs 5,000 with respect to direct loan origination cost. This is your transaction cost. To give this loan, we have to go through their papers. Some study we may have to do. No, just like that, we will not give the loan to someone. So for that, we have incurred some cost. To give this loan, we have incurred how much cost? 5,000. So this is a transaction cost. With respect to financial asset, transaction cost is added because the journal entry is, we are incurring this cost. So the entry will be financial asset loan given account debit. Financial asset loan given account debit to bank account. How much did we incur? We incurred this of 5,000. Okay, people. So that means what is the net value of financial asset? Financial asset ka balance. FA, here you debited 1 lakh, here you credited 3,000. So minus, here you debited 5,000. Add 1 lakh minus 3,000 plus 5,000. So 1 lakh 2,000. That is the initial balance of financial asset. 1 lakh 2,000. That's all is a drama over here. Transaction cost was similar. That we know what to do. We need to add this 3,000 non-cancelable fees. What we have collected. What to do for that? That also you have to adjust from the financial asset. That's all is a drama of this question. And we know whenever there is a transaction cost, actual rate and effective interest rate will not match. EIR will be something else. Okay, they would have given you. Check what is the EIR. EIR is given to be 5.7317%. Okay. All right. The borrower has an option to prepay the instrument and no penalty will be charged for prepayment. The contract meets SPPI test. So there is a prepayment option we have given, right? If the other party, borrower, if they prepay the loan, we will not collect any penalty. Okay. The contract meets the SPPI, sole payment of principal test. We have a couple of tests, no? Contractual cash flow CCF test and SPPI, sole payment of principal test. If both the tests are satisfied, we will go for ACM method. Indirectly, they're saying we're going for ACM method. Effective interest rate and all is required only for ACM any which way. What is the carrying amount of initial recognition? Initial recognition carrying amount we already know, 1 lakh 2,000. Okay. Then they are asking what impact does this prepayment feature have on the amortized cost calculation? Because of this prepayment, is this having any effect is what they're asking. First of all, people, this prepayment option is an embedded derivative. We have done a question on this. Okay. Because prepayment is decided based on market rate. Currently, the rate of interest on this loan is 6%. Later on in the market, if the interest rate becomes 4%, then borrower will repay this loan because now a cheaper finance is available. So borrower will not prefer to pay 6% interest. So if interest rate in the market falls, borrower will choose to prepay this loan and take a new loan, right? And market parameters will fluctuate, right? So this is an embedded derivative. Okay, this prepayment option, we have done a question. We have studied embedded derivative. So it is a embedded derivative. But here anyway, prepayment we are expecting or not expecting. We are not expecting the prepayment to happen. Whenever there is an embedded derivative, host and embedded derivative, we need to separate. Oh, yes, host is accounted as per the normal method. Embedded derivative we accounted as per FVTPL method. Unless they are closely related, which in this case you don't have to separate. We have studied all that as a provision, right? But anyway, here the prepayment is not expected to happen. So should we have to worry about this? Will this have any impact on our ACM calculation? We'll have absolutely no calculation, right? So you have to just write no, there's no implication on this because prepayment is not expected to happen. If it was expected to happen, then you need to check whether they are closely related or not. For that also we've checked that prepayment price, you have to compare it with the closing balance of the ACM balance. If it's approximate, and then I told you, right, we calculate in percentage. One question we had done in our regular class. It becomes a policy matter. You have to compare and then do it. You can refer that particular question. Okay. But here any which way prepayment is not there. So normal ACM table. So what is that? If you want, I think in this problem, ICAI has put up the ACM table for all the 10 years. 1 or 2 years quickly. They're prepared in a slightly different format. So I just wanted to tell you that our normal format also will get you same answer. So I've done it for 2 years. You can continue with normal format. What is that? Opening balance. It's a financial asset. So we'll collect interest income at what rate? Effective interest rate of 5.7317. So then when they have given 4 decimal, you take the exact 4 decimals only, people. Okay. Then receipt to then closing balance. Opening balance 102. 102 ka 5.73 if you do, you will get this much interest income, which will be transferred to SPL. Receipt is, we are actual, how much receipt we will receive. The loan given is 1 lakh, interest rate actual we are collecting is 6%. 1 lakh ka 6% is 6,000. That's your receipt. Closing balance will be opening balance and interest income you add, receipt you minus, you will get the closing balance. Okay. First year ka closing will become next year ka opening. Like this, do 10 year ka calculation. ICAI has brought in one more column and all. They've found out the difference of these two. And then they have adjusted with opening balance and got closing balance. Another way of presentation they've shown. But it's okay. You can continue with the normal presentation. No need to follow that. Okay, sir. It's simple working mode. Only takeaway is this, some extra fees if you collect. In that case, what to do? That was one of the extra fitting in this question. Rest everything is same. Okay. This question 12 is also repeat. It's on a performance obligation. Okay. Okay. 2 minutes. I'll review of this also. X Limited agrees to produce 2000 customized engines for use by customer A. So not one engine, 2000 engines we are producing on behalf of one of our customer. X concludes that the engine will transfer to the customer over a period of time. The performance obligation can be satisfied at a point in time or over a period of time, right? So over a period of time, we do percentage of completion method. At a point in time, we'll recognize revenue only when the performance obligation is 100% completed. So here they're saying it is over a period of time. So for that, we had three conditions, right? So they're saying it is over a period of time because this particular, it's a customized asset, no? So we don't have any alternative use. The third condition is that only. The asset, we should not, the supplier, the seller should not have alternative use to the asset, and we should have a right to collect the payment for the work done along with the reasonable margin, along with our profit margin. That was the third criteria, right? So that's what they've given over here. We don't have any alternative use because it is customized asset, and customer A is contractually obligated to pay X Limited for any finished or in-process engine, including reasonable margin, if contract gets terminated. So third condition is getting satisfied. Hence they say performance obligation is satisfied over a period of time. They've only given this. So what should we do? X Limited, that is a seller, already has the process in place to produce the engine and is given the design by customer A such that X does not expect to incur any significant learning curve or design things. Okay, we are customizing this product based on customer requirement. That's fine. X uses a method to measure progress towards complete satisfaction. Because it's over a period of time, we need percentage of completion or progress percentage. So they're saying, yeah, we have that. Okay, all this looks like goalie. What are we supposed to do? State whether 2000, look at this requirement. State whether that 2000 engines are distinct or not. The question is on distinct. Performance obligation. This is POCA definition. Performance obligation means it's a promise made by the customer or promise made by the entity to the customer to transfer a distinct goods or service or a series of distinct goods or services which are similar or have the same transfer pattern. Remember that POCA definition. So here they are saying whether these 2000 engines are distinct or not. Whether it is separate. Should we take 2000 are separate or not? Sir, in order to say goods or service is distinct, we say the customer should be able to use the goods on its own and the goods should not be highly interrelated or interdependent. If customer is able to use this goods separately and if these goods are not interconnected, then it is distinct. Of course, these 2000 engines are distinct, no? Right? Because customer can use this engine separately. One engine you can use it for one purpose, second for some other purpose. Is it necessary all the 2000 engines has to be used together? No, customer can use them separately. And are these interconnected, interrelated? No. That means answer is of course yes, it is distinct. Yes, answer is yes. Now they are asking whether this 2000 engines is a single PO or whether each engine is a separate PO. So they are saying whether we have one PO here or 2000 PO. Ideally 2000 engines are separate. So it should be 2000 POs, correct? But accounting wise it becomes difficult over here. 2000 POs means we have to account, we have 5 steps for revenue recognition. No? We have to apply it all together. Hence the second definition of PO comes into picture. If it is series of distinct goods or services, but if they are similar and have the same transfer pattern, if the goods are similar and if they have the same transfer pattern, though the goods are separate, we will not treat them as separate PO, we will treat them as one single PO. So same example we used to give TV channels, so 100 apples example I used to give and all in exam, in our class if you remember, right? So since the transfer pattern of these 2000 engines are, first of all, these 2000 engines are similar and they have a same transfer pattern. So considering that it is not 2000 performance obligation, here it is a single performance obligation case. Theory question this was, okay, nothing much. Next, question 13. Question 13 is also actually a little good question, I would say, in the context. So let's see what we can learn from this. This is on Ind AS 20 government grants. A has acquired equipment for 100 lakhs. Okay. Useful life 10 years, residual value 0. Depreciation is on a straight line method. Okay. So far easy. To encourage acquisition of asset, government will give a grant. So that means this is an asset related grant. No, because of the asset we are getting a grant. So when it's an when the monetary grant is related to asset, we can follow two methods: asset cost reduction method, deferred government grant method, or deferred income method. Okay, so now what is about this grant? If specified employment targets are achieved by the end of third year, the A limited feels they will receive a grant of 10 lakh. There's some conditions, so it is a conditional grant. So if those targets, those conditions, if they are satisfied by the end of third year, not now, then grant will be, government will give us a grant of 10 lakh. In other cases, if those conditions, if those specific employment targets, if it is not fulfilled, that is in other cases, we will receive a grant of 5 lakh. So that means we don't have one here. If we fulfill the condition, then we will receive 10 lakh in third year. If we don't fulfill those conditions, it's not like we will not receive grant. We will receive the grant, but only for 5 lakh. Amount of grant is varying over here. Okay, so it's not a refund case. We have an option to receive multiple amounts based on conditions ka fulfillment. On the date of acquisition as well as at the end of year 1, A expects to receive a grant of 10 lakh. So government grant is not receipt basis accounting. We don't have to wait till the time grant is received. On the day company feels they have a reasonable assurance that they will fulfill the condition, and on the day the company has a reasonable assurance that the grant will be received. Condition fulfillment ka reasonable assurance, grant receipt ka reasonable assurance. The day you get that, you can start your accounting. If you have received it, we will say bank account debit. If you have not received, we will say government grant receivable account debit. Okay. So first year company felt we will receive 10 lakh. We were reasonably sure that this target will be met and we will receive 10 lakh. This is not beginning, it's a typo. End, it should be. At the end of year 2, A has revised assessment in the light of new information. Now expects to receive only 5 lakh. Second year ending, we are saying we will receive only 5 lakh. I mean, up to 2 years, second year ending this change. No? So up to 2 years, our company was thinking we will receive 10 lakh. Second year ending, on that day when it came, now company is saying, 10 lakh, we will receive only 5 lakh. So in that case, there were no errors in estimate. They did not do any estimate. This is a new information, right? Estimate is based on the circumstance. If circumstance change, our estimates also will change. So this is not an error. Okay. A has assessed and concluded that the grant is in the nature related to asset. We already know that. So we can follow either asset cost reduction method ACR or deferred income. What does company say? A Limited wants to present government grant related to asset in balance sheet by deducting the grant and calculating the carrying amount. Grant they're reducing from carrying amount of the asset means we are following asset cost reduction method or ACR method. Now this change, estimate change now in second year, how should we account is what they're asking. Okay, how? Okay, first, now change happened only in second year. First, let's do the normal way. How much did you buy the asset for? 100 lakh. The moment you receive, you don't have to wait till the time grant is received, right? The day you have reasonable assurance, you can book it. So first year, second year, company was sure they will receive 10 lakh grant. Okay, till second year. So from 100 lakh original cost, reduce government grant, not received, receivable. How much? 10 lakh. So that means the net cost of the asset will be 90 lakh. So depre will be charged on 100 lakh now or 90 lakh. Asset cost reduction method, no? In asset cost reduction method, grant will be adjusted from the cost of the asset and then only depre will be accounted. So depreciation will calculate on 90 lakh minus residual value 0, life is 10 years. This change in estimate happened only in second year. So this if you do, you will get depre for 1 year. For 2 years, it will be 18 lakh rupees. So before this particular estimate got revised, our carrying amount is 72 lakhs. Correct, Aji? Okay. What do we normally do? Sir, in asset cost reduction method, when we receive the grant or when the grant becomes receivable, we'll reduce the grant from the cost of the asset. If the grant becomes refundable, then we will add back. Correct? No, first we will reduce and then we'll add back. Right? Here we have not received. Right? Because the grant you will receive only in third year. Right? But we were sure that we will receive 10 lakhs, so we started doing the accounting. Right? And then second year we feel we may not receive 10, we will receive only 5. So the amount of grant is changing over here. So the concept is pretty much same, but it's not a case of a refund. Right? So we'll have to work this out slightly differently. So what Ind AS 20 says in this case is, okay, instead of 10 lakh, initially you did this accounting from 100 lakh, how did you get 70 lakh? By considering the grant amount was 10 lakh. Now if this grant, now the grant amount is not 10 lakh, second year company is saying grant will received only will be 5 lakh. From the beginning, if this grant was only 5 lakh, what would have been the carrying amount? If we had taken 5 lakh and done the calculation, what would be the carrying amount of PP? First find that. 100 lakh, grant if it is 5 lakh means net cost will be 95 lakh, depre will be calculated on 95 lakh. 95 lakh carrying amount minus residual value 0 divided by life 10. If you do this, you'll get 1 year ka depri. Multiply by 2 to get 2 years ka depri. How much? 19 lakhs. So depri would have been 19 and carrying amount would have been 76. This would have been the data. Correct? No? If we had taken this. Now what the Ind AS 20 says is, currently our carrying amount is 72. Currently our carrying amount is 72. Now we have booked a grant of 10 lakh, right? But receivable is only 5. How much excess have we booked? 5. Now don't add this 5 lakh directly to the cost of the asset. When you receive the grant, you reduce the grant from the cost of the asset. If it is excess or if the grant becomes refundable, what do? Add the grant back to the cost of carrying amount of the asset. Now what Ind AS 20 is saying is, don't add 5 lakh directly to the carrying amount of the asset. Because if original estimate was taken as 5 lakh means carrying amount would have not been 72, it would have been 76. So out of this 5 lakh, total grant you have to adjust is 5 lakh, correct? But out of this 5 lakh, 4 lakh you'll adjust with PP. Why? From 72 carrying amount of PP would have become 76. So only 4 lakh you'll adjust with your PP. So what about that 1 lakh? That 1 lakh check what happened? How much debris you actually accounted for 2 years? 18, right? If the original estimate, if you had taken it as 5 lakh instead of 10 lakh grant, if you had taken 5 lakh grant, what would have been the debris? It would have been 19. You have accounted only 18, but debris would have been 19. That means depreciation is undercharged. Instead of 19, we have accounted only 18. So that 1 lakh, you'll adjust it as depreciation in the current year. So the entry what you'll pass, if you have paid this amount, then you'll write PP balance from 72, you have to make it 76. So PP balance we have to increase. PP has debit balance. How do you increase? Debited. So PP will be debited to the extent of 4 lakh. Grant you have to pay. You have considered extra grant. No? So grant, if you have to pay this amount, I don't think so you have to pay this amount because now you have not yet received. If by chance if you have to pay this amount means you will credit bank by 5 lakh. If it is still payable means you will write GG receivable or GG payable rather you could say. Okay, GG payable account debit 5 lakh. Or you can adjust from initially or rather you can adjust from GG receivable only. Because initially, at year 1 may what entry you would have passed. If you have received the grant, you would have written bank account debit 10 lakh or you would have written GG receivable account debit. If it is not yet received, you would have written bank account debit 10 lakh to PP account. Correct. Now, this is the entry you would have passed in year 1. Now, you need to reverse this. How much extent? 5 lakh because you have taken 5 lakh extra grant. No. So, same entry. So, you will credit GG or government grant receivable to the extent of 5 lakh. But don't adjust 5 lakh against PP, adjust only 4 lakh. Because of this calculation. Okay, currently it is 72 lakh, but if you had taken 5 lakh as the grant, carrying amount would have been only 76. So from 72 you can increase the PP value and get it to 76. So PP you will debit only to the extent of 4 lakh. 1 lakh you will account it through depreciation. So charge additional depreciation in the current year. Indirectly it has an impact on SPL. How much depreciation goes to SPL on, So 1 lakh. So this is the effect you need to give in case of government grant. Okay, people. Till now we had questions on government grant refundable. So this is the estimate wala revised problem. We have not received the grant. We will receive third year, but our estimates has changed now. Initially it was one amount. Now it has become different amount. How to solve such question? This particular data or this particular question is helping you with that. That way it's a good question. I will again revise this or review this question once more. If you want, you can keep this question also as an LDR. That consolidation question and this question you could say. I can keep it as LDR from this particular RTP. The rest I think is manageable. 14th one is a repetitive. We have a similar one. Lessee enters into an agreement with lessor for a period of 5 years to lease a floor of a building. Lessee is required to make a fixed annual payment of 420. So 420 payment lessee has to make to the lessor. A total payment of 21 lakh over a 5-year term. 4,20,000 is for 1 year. For 5 years if you do, 4,20,000 into 5 is 21 lakh. That 420 ka lease payment breakup they have given. Out of this 4,20,000 for building rent we are paying 240. Then common area maintenance is 84. So I mean this is what? For building it's a lease component. It's a lease component, right? There's an asset. But for this common area maintenance, are you having any asset? No. I mean this what? This 84,000 only we used to call it as NLC or a non-lease component. We are not getting any asset in return for this 84,000. We are not getting any right to use any asset for this 84,000. We got a service. So this is a non-lease component. Okay. And 60,000 of this, they have given 420 ka breakup. If you add all this, you'll get 420. In this 420, 60,000 is for property tax. Property tax is not a service. You're paying it to the government, right? You're not getting any specific service here. Okay, so that means this is not, don't say this is NLC. This is not NLC because you're not getting any specific service here. And for building insurance, 36,000. Building insurance benefit will be given to the lessor if something happens to the building. So I'm not getting any specific service here. That means what? So here in this contract, okay, we have lease component and non-lease component. That is what lease component is building, current, and non-lease component is common area maintenance. So these two, whatever payment you are making, right? So these are not NLCs. So what should we do for them? Right? These two payments, whatever you are making, has to be allocated among lease component and non-lease component in standalone selling price wala ratio. But there is also a choice. What choice? Ind AS 116 gives a choice that lease component and non-lease component company can choose not to separate. We can use practical expedient and not separate lease component and non-lease component. So if company has chosen that, then 4,20,000 will be lease component value. You can take 4,20,000 as a lease payment and do Ind AS 116 ka accounting. That's it. Here, what has the company chosen? Check. So from lessee's perspective, standalone selling price of the rent alone, lease component ka standalone selling price is 264. Standalone selling price of that common area maintenance, that is non-lease component ka standalone selling price is 96. So SSP of both are given. So if you add this, it will not match. Okay, don't, because standalone selling price and the actual transaction value could be different, because actual transaction value is a negotiated number. This is the normal standalone selling price, means this is a normal, you could say a fair value or a benchmark value, but actual transaction value can be same as benchmark, or it could be little high or little low also. Now what has a lessee done? Lessee has not elected, the keyword there is that not. Lessee has not elected to apply practical expedient. Sir, if he is not elected to apply, means you need to segregate the payment. How much payment? Total you're paying how much? 420. 4,20,000 you're paying. You have to segregate among what? Lease component and non-lease component. In what ratio? In their standalone selling price ratio of 264 and 96. So 4,20,000 ka total payment, you have to segregate in 264 and 96 wala ratio. So how much will be towards, when you allocate this in this ratio, towards building rent or lease component, you will get 3,08,000. And towards maintenance, that is non-lease component, you will get 1,12,000. There is a slight round off error over here. In the ICAI answer, they have taken 3,07,800 something. I have rounded off and taken it as 308. It's your call. Fine. You can keep the decimal or round it off, your choice. Okay, that's your segregation. That's all it is. That's what was the requirement of this question. How you'll do. How the upper payments are allocated. Obviously, they'll be allocated in SSP ratio. Okay, G. But you'll have to write a little bit of blade. And lessee has an option to choose practical experience, not to separate. Okay, here lessee has not chosen. So hence we'll have to allocate that payment in standalone selling price ratio. And this particular property tax and building insurance are not non-lease component. Like this 2-3 points you have to write. Show the allocation and do it. That is provision. It is there. We've done a question. You can refer that as a template and solve. Here only I'm discussing the fine print. So the summarized things. Okay, question number 15 is on Ind AS 7 cash flow statement. An entity invests 10-year bonds with a face value of 6 lakh by paying 2,31,500. We are investing, so it's a financial asset. Face value is 6 lakh, but did we buy it for 6 lakh? No, we bought it for 2,31,500. So it's an investment. So it's a cash flow statement. So obviously it's an investing activity. This 2,31,500 is an investing. Under investing activity, you will show it as negative. Effective interest rate is 10%. The entity recognizes proportionate interest income in SPL over a period of time. Hang on, people. Sir, this is effective interest rate, EIR, actual, right? We get the receipt, we get the interest on an actual rate, but we account it in our books based on effective interest rate. So this 10% is not actual rate. It's not actual interest rate. It is effective interest rate. Here, looks like there is no interest. Why, sir? Sir, the face value of that investment is 6 lakh. We purchased it at a heavy discount of 231,500. You remember deep discount bonds, zero coupon bonds and all works like this. Where we get it, we buy it at a heavy discount. On this instrument, interest will not be paid. The company will not pay any interest to us. Ultimately, this bonds will get redeemed at face value. Meaning, we bought it for 231,500 now. Term is 10 years now. After 10 years, we will get back 6 lakh. We purchase for 231 and we will get back 6 lakhs. So the difference between these two becomes our return or interest. So company will not give any interest on a yearly basis or quarterly basis over here. That's how this works. How interest income will be treated in SPL is what they're asking, or in cash flow statement. Sir, on interest income, don't say this interest income is an investing activity. Are you receiving any interest here? No. For your purpose, I've prepared ACM table also. Check here. You purchase for how much? 2,31,500. You will book finance income at effective interest rate of 10% they have given here. 2,31,500 ka 10% is this amount. But the actual receipt is 0. Because we will get the money only in 10th year, full 6 lakh we'll get. Every year interest we will not get. So these two addition minus this gives you your closing balance. So they are saying for this 23,150, what you are booking as interest income in your accounts, where you will show or how you will show this in your cash flow statement. This you will not show anywhere in your cash flow statement because, sir, are you receiving this? Are you receiving this? No, actual receipt is 0. That means there is no treatment for this, no impact in cash flow statement because we are not receiving this. That's the reason. So you can't show this as an investing activity. Done now. But yeah, in operating activity, you may do it as an adjustment if you're following indirect method. This has gone to SPL. So your SPL has increased. So it's a non-operating income. So you will minus. That's the treatment you will do it in your operating activity. But here in investing activity, you will not show this anywhere because you have not received this. Keep this in mind. They've asked this question specifically under investing activity, keeping that in mind. If you want, you can also write under operating activity. If indirect method is followed, this particular 23,150 will be reduced as an adjustment as non-operating income. Like that, you can write. That's fine. It's not called out here. If you want, you can mention that. How maturity proceeds of 6 lakh? 6 lakh we will receive finally, when? 10th year. That, how will you treatment there? How will you treat is what they're asking. So at the end of 10th year, you will sell your investment or these investments will get redeemed. So this 6 lakh will be shown under investing activity. But don't show directly 6 lakh. You need to bifurcate or segregate. Total 6 lakh fully will come in the investing activity only. But you need to show how much did you invest? 231,500. So you need to tell out of the 6 lakh, 2,31,500 is for a principal recovered under investing activity only. 6 lakh out of the 6 lakh, 231 is a principal recovered balance. The difference between these two is interest income. That you will show in 10th year cash flow statement. So 6 lakh minus 231,500 if you do, you will get 368,500. That you will show it as an interest received when in cash flow statement for 10th year. Both this you will show under investing activity only, but by segregating. You will not show 6 lakh under investing activity, but by separation. That's about this question. Easy, simple question. 16th question is not required. Same 2-3 questions we have in this question number 38, 39, 40 in our class notes. I mean to say regular class notes. I'm sure in fast track notes also this is there. Onerous contract question. You can manage on your own also this one. The same question is available in our class notes. Yes, people. So that's about your RTP people. So overall pretty straightforward RTP except that consolidation wala question and maybe that one more financial instrument wala things and government grant. Those three you could say you can review them once. Rest everything is pretty straightforward. Okay. Now in the same video I'll continue. MTP 1 no May 26 so as well as MTP 2 of May 26. Both the MTPs. So not even one single new question. All the questions are repeat. Right? Either it's from study material or it's from the previous RTPs, MTPs. So no new questions has been framed off from this particular chapter. I've just given a reference. I'll quickly show you. When I write NR, it means it's not required. These questions straight away available in our class material. Okay. Wherever this question is taken from previous MTP, like this question, if you say case 2, it's from November 24 ka MTP 1. Like that, I've given a reference. Okay. So wherever it is possible. This is now RTP November 24 ka question. So if case-based question, your descriptive question, everything is either from study material or previous RTPs, MTPs. Wherever it is possible, I've just given a reference over there. Okay. So none of this is required, people. Both for MTP 1. I'll quickly show you for MTP 2 also. MTP 2 also same thing. Not a case-based question, not a descriptive question. None of them you have as a new question. Everything is a repeat. So yeah, so I'm just wherever possible, as I told, I've just given a reference of that. Okay. But anyways, all this are there anyway. Even MTP videos are available in YouTube as well as our course. So you can refer them in case you want to solve them once more. Or if you already watched them, then these questions are automatically covered. So yeah, that's pretty much with respect to, see, everything is repeat, not even one. Okay. So that's pretty much with respect to this May 26 ka RTPs as well as both the MTPs. Okay, people. So yeah, so I know that exam is nearing, hardly another maybe 20 days for our examination. So yes, I think the heart is buku buku. You're feeling that pressure. It's common. So that feeling anxious, feeling that pressure is everybody will go through that. No matter how your preparation is, you'll still feel that. There is always a certain element of fear that we may not forget, or whatever we have studied may not be sufficient. So those sort of feelings, trust me, are normal. So if you're going through that, don't freak out. It's fine. All I would say is don't spend too much time on it. Don't overthink, or don't go into that loophole of thinking on the same things again and again, right? It's fine. 5 to 10 minutes. If those thoughts come, just go with it. It's fine. After that, get back to studies. The last 15-20 days, people, can have an immense impact on your results. So don't give up now. Don't lose the steam now. We see that many students, the last 15-20 days, they feel too much overburdened. They've been studying non-stop for 2 months, 3 months, 4 months. So they feel it's becoming too much, sir, and all that, right? Please, last 15-20 days, just continue. Yes, I know it's a little tough. You've been putting hard efforts the last 2-3 months. I know that. I do understand. But this is crucial time, people. This last 15-20 days can change your result from fail to pass, from unsuccessful to successful. Yes, we've seen that so many, because we know many students tell that, like on the examination day, I just needed that after you write the examination. No, some of us feel just 10 minutes if I had got extra, I could have written one extra question, right? It happens. When we write the examination, we always feel I need that extra 15-20 minutes. Same with goes with our preparation also. We feel sometimes that 1 or 2 days extra if we had got, our results would have changed, right? So it's always the case. So last 15-20 days, man, still hang in there. Give your best, right? I'm sure results will come your way. Next time I will definitely meet you as a fraternity member. Okay, people? So wish you all the very best for your examinations and your career. Take care. Look forward to seeing you all. Take care.